we have looked at step acquisition where we say that, okay, control can be achieved in stages. The company will buy 10%, they will buy 30%, then they will now buy 40%, then they will now be having more than 50%. The same way, the company can also have 60% and they will try to buy additional shares. We look at those issues and how we go about them. Okay. What we are coming to look at right now is okay. What we are coming to look at right now is what we call disposal of a subsidiary. Okay, so we are coming to look at disposal of a subsidiary. So disposal of a subsidiary. So disposal of a subsidiary. Okay. You see, a parent can acquire a subsidiary and they realize the subsidiary is not doing well. Then they will now say they are going to sell the subsidiary. Or they will sell the subsidiary. They will just sell the subsidiary off. Okay, and the subsidiary will now be seen as what? A discontinued operation. Okay, so a parent can acquire a subsidiary and they will decide to sell the subsidiary because the subsidiary is not doing well. So they will classify it as held for sale and they will dispose it. Okay, if they dispose a subsidiary, there are so many questions that you have to ask yourself. So A has acquired 70% shareholding in B. Okay, maybe 2 years after the acquisition, A decide to dispose or A decides to dispose 15% of its shareholding. What will be the percentage holding? What will be the remaining percentage holding after the acquisition, after the disposal? A acquired 70% and they have decided to dispose.
55.
Okay, they will be
55.
having 55. This 55, it can still be seen as what? The A is having control, isn't it?
True.
Okay, so A is still the owner of the what? Of B. So A will still be consolidating the B. Okay, so we can have a situation where the parent will sell and they will still have control again. It means that they will now be seen as what? As the majority owner of that particular company. Okay, so they will still be consolidating. Okay, but what you are going to be doing is that you will just see that, okay, at the time, this one is having what? NCR will be 30%, isn't it? At the time of the 70%, NCR will be what? Will be 30%. Okay. The time that they have sold the 15%, NCR will now be what?
45.
Okay, 45%. Okay. What is happening? You can see that NCR is buying the 15% from what? From the parents. Okay. The people that will be buying the 50%, they'll be having 45. They will still be seen as what? As a minority interest or the NCR or the non-controlling interest. So we just say that if the disposal still results in control, maybe the parent will sell part of each shareholding, the remaining portion will still indicate a control. There will be more than 50% or equal to 50%. Then we say that the transaction is between the parent and then the what? The NCI. So the transaction is between the parent and the NCI. So it's just like you have 90% of the company that you are running. You are the majority shareholder. So it's just like you are the owner of the company. Okay, so you have decided to sell 20%. You'll now be having 70%. Those who will buy the 20% will still be part of the people who are the minority shareholders. So they will still be seen as part of the shares that you are not controlling. That will be called the NCI. So the 20%, it can be new people that will be buying, but those people will still be classified as NCI because that's the 20 plus the 10 is the portion of the shares that you are not controlling, that you don't have control over, and that is still the NCI. So if the disposal is going to result in control, then the transaction is seen to be between the parent, and then the NCI. So a parent can acquire a subsidiary and they will decide to sell the subsidiary because the subsidiary is not doing well. So they will decide to sell it. They can decide to sell part of the shareholding. They can decide to sell all. They can decide to sell half. They can decide to do anything that they want to do in terms of selling. Okay, so for the disposal tool, we have two issues like the step acquisition. We have from control to control and from non-control to what? From control to non-control, sorry, from control to non-control or from control to control. We are going to look at it one by one. The one that I have spoken about is from control to control. The parent is having 70, they have sold 15, they are still having 50, 55. The 55 is still an indicator of control. So they will still be consolidating. They will still consolidate like normal. Okay. What if the parent has 70% and they have now sold 30%? What will be the percentage remaining? What will be the percentage remaining now?
40.
Okay. This 40, does it signify a control?
No, they will lose control.
They lose control. So it means that they are no longer the owner of what? The subsidiary. So it means that they have disposed their ownership to a different person. So since you have disposed your entire ownership or you have disposed ownership, it means that you have sold the company and you are no longer the owner of the company. So you just have to determine profit on what? On the disposal. So when the parents lose control after the disposal, it means that that is a sell. They have sold the company. They are no longer the owner of the company. So they are just buying part of the shares in the company. They are now becoming a minority holder. So when there is a loss of control, we determine profit on what? On the sell. When there is a loss of control, we determine profit on the sell. But this particular 40% will be classified as a associate. It will be an indicator of significant influence. So this one will be classified as investment in associates. Investment in associates. Okay. Investment in associates. Okay. The 40% can still be an indicator for control, or the parent might be having 40% and still be having control. That one, the question will tell you whether the question will tell you why you should take the 40% as control. They can tell you that the parents still have the power to remove and also appoint key management people or key management personnel of the board. So if they say that the parents still have the power to remove important personnel or key personnel of the board of the company, it means that the parents still have control. You cannot appoint board of directors or you cannot appoint a key management personnel if you are not the owner of the company. Or the question can also say that the remaining 60% are being spread among numerous people. In that case, you will still be seen as a majority shareholder. But if none of these things are being said, the 40% will be a loss of control and the parents will classify it as investment in associates. Then you have to calculate again on the sell. It means that you have sold a company and you have to recognize as a profit on the sell. So we take it one by one. We are going to take from control to control. The first one is from control to control. So we have control to control. So the first one is control to control. You will sell and still be having more than 50%. So if it is from control to control, the transaction is between the parents and the NCI. The meaning is that the parent is selling that portion to the NCI, like the way we do it under the step acquisition, where the NCI is selling part of their shareholding to the parents. What do we do? Okay, the parent will be receiving a certain amount of money and the NCI will be paying. So the parent will be selling the shares for a certain amount of money. You just ask yourself, what is the value of the what? The net asset at that date. What is the value of the net asset at that date? So the time that you are selling, you determine the total net assets. If I say the total net assets, the meaning is if you are using fair value method, then you include the goodwill. So if you are using fair value method, you include the goodwill. So the fair value of the assets, including the goodwill at the date of the sale. Okay, you just find the portion that the parent is selling. Okay, the sale, the portion that the parent is selling will be the percentage, which is the 15% multiplied by the net asset. Multiplied by the net asset. The net asset over here, if you are using fair value method for the NCI or for the goodwill, or you are using full goodwill method, you add the goodwill to the net assets. Then you find the 15% of it. I can also show you another way of finding the 15%. You can find the parent portion of the what? Of the net asset and now do 15/70 times the parent portion, like the way we did it under the NCI step acquisition. But just find 15% of the net assets, including goodwill, if they are using fair value method for the valuation of the what? The NCI. Okay, so that will give you the portion that the parent is selling. So what is the process? How much is the parent receiving? So you look at the portion that they are selling, the amount that they are receiving. So maybe this will be an income, this will be an expense. So then the remaining portion over there, any figure over there will go to other components of equity, like the way we did it for other components of equity, like the way it has been done for the step acquisition. So if the transaction is between the parent and the NCI, just find the portion that the parent is selling to the NCI and the amount that the parent is receiving. So let's assume that the parent is having 70%. The parent is having 70%, and they have now decided to sell 15%. At the date of this one, the net asset is 200,000. And the goodwill, we look at the goodwill at the date of the transaction. So if there's any impairment of the goodwill, you calculate it up to the date. So we are looking for the goodwill at the date of this particular transaction. So you find the goodwill at the date of what? Of the selling of the 15%. So what is the goodwill? Let's assume that the goodwill is 50,000. Okay. And the proceeds that the parent is receiving is, let's say, is 70,000. Okay. Okay, this one we don't have to calculate the NCI. I can also use the NCI for this particular one, but that is not an issue here. We just want 15% of this one because we assume that we are using the fair value method for the. So let's look at the amounts, the value of the net asset that the parent is selling. So value of the net asset that the parent is selling. So you have your proceeds. You have your proceeds of 70,000. Then you find the portion, the transfer that the parent will be doing to the NCI. So the transfer, this will be added to the NCI. So let's come here. That will be 0.15. That is the portion that we are selling, multiplied by 250,000. The net asset that will be given to you will be excluding goodwill. So you add goodwill to it. 15% of 250,000. What are we getting?
37,500.
Okay, 37,500. All right. So what is the difference? Okay, you can see that that is a gain, isn't it? Because
Yes.
we are selling only 37,000 for 70,000, but we don't recognize this as a gain. So the entry will be, you debit cash. Okay, you are going to be debiting cash because you'll be receiving cash for this particular transaction. You'll be receiving cash over there. So you receive a cash of 70,000. Then you credit NCI. So you are going to be adding 37,500 to the NCI. Okay, NCI will now increase by 37,500 because they are buying 37,500 of the net assets. Okay, then you will now credit other component of equity, which is 32,500. Don't send it to retain earnings. Don't send it to retain earnings. So it will be treated as other component of equity. That is how we go about it. So if it is from control to control, just ask yourself, how much is the parent paying? And what is the portion that the NCI is buying? You find a difference. The difference will be treated as, will be sent to other components of equity. If it is a loss, it will be sent there. If it is a gain, it will be sent there. That's how we go about it. So it's very simple. It's very simple.
So where it's partial goodwill, do you still add the goodwill?
No, if it is a partial goodwill, it means that the NCI will not be having a be having a share of the goodwill. So if it's a partial goodwill, NCI, they are not interested in the goodwill. That's why they are asking you to use proportionate method. So they are only interested in the share of the physical assets. So if there is a partial method, we use only the 200,000. So you find the 15,000, 15% of the 200,000. Okay. Nick, are you okay?
Yes, sir.
Okay. So if you are using partial goodwill, use only the net assets. But if you are using full goodwill, it means that NCA is also having goodwill. So they will also be interested in the goodwill again. So they will buy part of the goodwill. Okay. This one, don't go. You can also do this like this. You can see that the total net asset is what? The
Yes.
total net asset is 250,000, isn't it?
250,000.
Okay. At this date, they can give you the value of the value of the NCI. At this date, they can give you the fair value of the NCI. Okay. At this date, they can give you the fair value of the NCI. I want to do something so that I'll be able to get. Okay. Let me get the value of the NCI value. Okay. At this date, they can give you the value of the NCI. So they can say that this, at the date of the sale, the value of the NCI is 175,000. Okay. You can also calculate this particular value like this. Okay. You can see that the NCI over here is fair value of the NCI, isn't it? Okay. So you ask yourself, the portion of the NCS goodwill is here. So you can ask yourself, the total net assets, the total net assets, the total net assets, it will be the net asset without goodwill. So the net asset without goodwill, that will be 200,000. And then we have the goodwill of 50,000. This will be 250,000, which is the value of the total company. But NCA, this is 100%. But the NCA is having 175,000. Okay. What will be the portion that will be for the parents? Hey,
75.
I'm coming. Okay, this will not give me, NCA should not be 175. Let me recheck that one again. Okay, NCA should be 75,000 rather. Okay, NCA should be 75,000. Okay, so NCA, they are telling that NCA is 75,000. Okay, NCA is 75,000. So this would be 175,000. Okay, this 175,000 is for the parents. Is the parent portion of the net asset, isn't it? Okay, so the 250,000, NCA is having 75,000 at that date, and the parent will be having 175,000. So this is equivalent to 30%, and this is equivalent to 70%. Okay, the parent is selling what? 15% out of their what? Their 70%. So let's find the portion that they will be selling. So let's find the transfer that they will be doing to NCI. So the transfer will be 15 over 70, because this is 70. What will be 15% times 175,000? What are we getting? What are you getting?
That's 7,500.
Okay, 37,500. So this 37,500, they are paying 70,000. So the difference will be 32,500, like what we have gotten over here. So sometimes they can give you the NCF value. If they give you the NCF value, just apply for the total assets and find only the portion that the parent is selling. Or you can still apply the 15% on the total what? Net assets. You'll be getting the same answer. That is very simple. That is very simple. Okay, so let's look at this is how we go about from control to control. So what will happen from control to non-control? Okay, so from control to non-control, control to non-control will be a situation where the parent has sold all of its entire shareholding. They are having 0%. They will sell all. It means that they don't have control over that particular company again, or they will decide to sell part of it, but the remaining portion will be less than what? 50%. Or they can sell and now be having a significant influence over the what? Over the investee, and that will be classified as investment in associates. Or they can sell and the remaining shareholding will be less than 20%, which will now be classified as a mere investment. It will be classified as what? Financial assets. If the percentage holding is less than 20%, the investment will be classified as a financial asset in accordance with what? IFRS 9. Financial asset through equity instrument. So either it will be through profit or loss or other comprehensive income. But if the percentage holding is more than 20%, but less than 50%, that will be seen as what? Investment in associates. So we are going to be using the equity method to account for that. Okay.
Please come again on that.
If it is from 20% to 49%, 20 from 20 but less than 50%, that will be classified as investment in associates. Investment in associates. Okay, and we are going to be using the equity method, equity accounting method. The equity accounting method, we look at the investment, we add their share of the profits. If there is any impairment, we subtract it. If there is any dividend paid, we subtract it. If there is any provision for unrealized profit, we do justice to it. This one is more examined in financial reporting than the corporate reporting. Okay, so if it is below 20%, it is what? A mere investment, which will be a financial asset in accordance with financial instruments. But if it is more than 20 but less than 50, that will be investment in associate. But if it is 50 and above, then that will now be a subsidiary. Then you consolidate. Okay, so the parent can decide to sell all of its shareholding so that they will be having a zero shareholding there. They can decide to sell it and the remaining shareholding will be less than 20%. Then they will now classify that as a financial asset. Or they can sell and they will have a percentage holding that will be 20 and above, but it will be less than 50%. And that will now be classified as an investment in associates. How do we account for a situation where the sale results in a loss of control? Okay, at the date of the sale, you have to determine gain on disposal. Okay, it's just like you have a shop. You have a shop that the shop is your own. Okay, now you have sold the shop to someone. Now you are having only 30% of the ownership. First, it was 100%. You are the owner. Now you have sold the shop and now having 30% of the interest. It means that the 70% person is now the owner of the company. You are just like a partner. So what you do now is that it means that you have sold the shop and you have to determine what profit on the sale. But if you are having 100%, but you have sold only 20%, you are still the owner of the company. So you are still the owner who will be running the company. So you are not selling the company. You are still the legitimate owner of the company. But if you sold 70% and you are now having 30, it means that you don't have control over the company again. You are not the one who is going to be running the company. You are not the one who is going to be taking decisions for the company. It means that you have sold the company and you have to recognize a gain on the what? On the sale. That is how we go about it. How do we recognize the gain? Okay, first of all, you ask yourself, how much is the parent selling the shares? How much are they selling the shares? You get a proceeds. The proceeds from disposal, you get it. You ask yourself again, is the parent selling all the shareholding? If the parent is selling all the shareholding, then you ask yourself, what is the portion of the parent what? Net assets at the date of what? The sale. So let's look at this. Let's assume the parent is having 70%. Okay. They have sold the 70% for a proceeds of 500,000. Okay. At the date of this one, the net asset was 250,000. Okay, the goodwill that we use is the goodwill at the date of the sale. So if there's any impairment, we take it and know the value of the goodwill at this one. So we normally use the unimpaired goodwill. Unimpaired goodwill. So the goodwill that is yet to be what? To be written off. The goodwill can be 200,000 from the beginning, but you have done 2 years already and the goodwill has impaired by 10%. It means that you are going to be using only 80% of the goodwill will be remaining at this date. So we use the goodwill that is here to be impaired. We don't use the goodwill at acquisition. If there's any impairment, you ask yourself, so what would be the value of the goodwill at this particular date? That's the goodwill that we use. So let's assume that the goodwill is 100,000 here. Okay, and the value of the NCI is 50,000. Okay, let's assume that the net asset is 350. The net asset is 350. The parent is selling all the 70%. The parent is selling all the 70%. What will be the gain from this particular disposal if you just use your eyes to determine it? The parent is selling all the 70% for 500,000. The net asset of the subsidiary at the date of the sale is 350,000. The goodwill at the date of the sale is 100,000. And then the NCI at the date of the sale is 50,000. What will be the gain on the disposal? What will be the gain on the disposal?
200.
Is it 200?
Yes, sir.
I think it's
No. Sorry. It's not
Okay.
200.
Is it 100?
Yeah, it's supposed to be 100.
It's 100.
I'm sure it's 100, isn't it?
Yeah.
Okay. The total value of the subsidiary is what? 450,000, isn't it? The total value of the subsidiary is 450,000. Are we correct?
Yeah.
Yes.
Okay. But this value is for both the parent and then the what?
And the NC.
NCI.
Okay.
Yeah.
The parent is not selling 100%. If they are selling 100%, that is why we use the 450. But they are selling only 70%. They are saying that the 30% of this value is what? 50,000. So what will be the portion that will be relating to the parents?
$400,000.
That will be 400,000. So the parent is selling 400,000 for what? 500,000. And the gain will be what? 100,000. Are you okay? All right. But what you are going to see in the exam is not this one. The parent will not sell all of them. They will sell parts, but the remaining portion will not give them a control. Okay. So they can say the parent has sold 40%. Okay. And the parent has retained 30%. So they will say the fair value of the interest retained. They will tell you the fair value of the interest retained the fair value of the interest return. So let's change this value to 300,000. Okay, they will say that the fair value of the interest return is 100. Okay, the fair value of the interest return is 150,000. Okay, the fair value of the interest return, it means that the 30% is now 150,000. Okay, so this one too is very simple. The parent share of the net asset is what? 400,000, isn't it? Is that correct?
Yeah.
Okay, it's 400,000. Okay, but are they selling all their shareholding? Are they selling all their shareholding? Okay, they are selling only 40, but they are saying that the fair value of the remaining 30 is 150,000. So what is the portion of the net asset that they are selling?
250. 250.
That would be 250,000, isn't it?
Yes, sir.
So the 250, they are selling the 250 for.
Understand.
Yes, yeah.
I'm confused though. The 400, how do you get the 400?
Okay, the 400 is the net asset without goodwill. Okay, then
Yes.
we add goodwill to it. That will be the total value of the subsidiary.
Yes,
Okay.
which is 450.
Okay, the 450 is for both the parent and then the NCI. Is the total value of the company, which is owned by NCI and then the parent.
Okay.
They are saying that the NCI portion is 50,000.
Okay.
So it means that the parent portion will be.
I thought we calculated 70% of the 450, making the 400. That's all.
No, we are not using proportionate. We are using fair value.
Okay.
All right. Okay. So it's 400,000. Okay. So we find if they are selling all, they will have a gain of 100,000. But they are not selling only 40%. But they are telling you that the fair value of the 30% that is remaining is 150,000. The parent is having a total of 400,000. That is 70%. And they are saying that the remaining 30% is 150. So if I'm selling only 40,000, it means that I'll be what? I'll be leaving 150 out of the total. So this will now be 250,000. So the parent is selling only 250,000 for 300,000. And the gain will be what? Will be 50,000. So let's look at how we got that particular figure now. I'll just, the format that they have been giving you. Okay. Let's look at how we got the figure. We have the proceeds. We have the proceeds of 300,000. Okay. So this 300,000, we look at the parent share of, okay, the parent portion of net assets disposed. Okay, portion of the net asset disposed. How do we get that? We look at the net asset at the date of disposal. They will give it to you or you calculate it, which is 350,000. Okay, then we add the goodwill. The goodwill is 100,000. Then we subtract the NCI of 50,000. Then we subtract the interest return. Okay, interest return. That will be 150,000. So you can see that we are selling only 250,000. Okay, and this will be 50,000. That will be the gain. Okay, that will be the gain. Okay, this one, this is how we calculate. This is how we got these figures. Okay, okay. Let's see here. What are we doing with the NCI? We are subtracting the NCI, isn't it?
Yes.
Okay. Okay, we are subtracting the NCI and this one over here. So we can also say that we are not going to subtract the NCI. The effect of the NCI on the net asset will be a reduction. So we are not going to subtract the NCI, but rather let's come and add the NCI and then the interest return to the proceeds so that we just take the 350 and 300,000 without subtracting anything. So someone can say, okay, let me just calculate the gain by having the proceeds of 300,000. Then they will add the NCI of 50,000. Then they will add the interest return. they'll add the interest return of 150,000. Then they will now be having 500,000. Then they will now come and have the net assets of 350,000. Then they'll have the goodwill of 100,000. So the person will now have 150,000 and have 50,000 as the gain. Okay. What I want to tell you is that the gain on disposal is calculated like this. This is how we calculate it. You ask yourself, what is the process? So the gain on disposal, which will be taken to profit or loss or retained earnings, is calculated like this. First of all, you take your process. Then you ask yourself, what is the net asset at the date of the disposal, which they will give it to you or they will ask you to calculate. This one is corporate reporting, so they will always give you this information. Okay, so you take your process, you add the NCI, you add the fair value of the interest that is not disposed, the portion of the shares that is not disposed. Then you have your value here. Then the net asset, you have to calculate the net assets. So you calculate the net assets, you add the goodwill, then you subtract all of them from this one. Then the figure that you get is the gain. This is how we calculate it. And this is the reason behind the formula that they have been giving to you. So it's just common sense that they are using to get the formula. Okay. So this is how we go about it. This is how we go about it. Sometimes the question can ask you to calculate the gain, then they'll ask you to do it in the books of the parents, in the books of the subsidiary. That is not an issue that we have to waste time on that one. Let's take some simple try questions. Then we move on to the issues of the day. Okay, let's no, that will be too much. Okay, let's take the example one, and we take the, let me see whether example 3 also do. So let's take those two simple examples to see whether we can get an understanding of the issues and then we move on. So Austin, take the example one for us.
Okay, sir. Example one.
Yeah.
Is any
Can you see?
no, sir.
Okay, Senior Augustine, are you there?
Yes, I'm here.
Is it on first January?
No, you can't see. Senior Augustine, take it for us.
Okay. Rock acquired a 70% investment in Dog for 2,000 2 years ago. It is group policy to measure non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest at the date of acquisition was 800, and the fair value of Dog's net asset was 1,900. The goodwill has not been impaired. Rock has made a disposal of shares in Dog. The net asset of Dog recorded in the consolidated financial statement at the date of disposal were 2,400. Rock pays tax at 30% required. Rock has disposed of all of its shares in Dog for sale proceeds of 3,000. Calculate the profit or loss on disposal that would be recorded in Rock's individual statement of profit or loss, including the tax charge. The Rock Group consolidated statement of profit or loss, including the tax charge. Now, assume that Rock disposed of half of its shares in Dog for 1,500. and that the remaining holding had a fair value of 1,300 at the date of disposal. Calculate the profit or loss on disposal that would be recorded in the consolidated statement of profit or loss, ignoring any tax effect. Explain how the residual holding would subsequently be accounted for in the consolidated statement of financial statement of the Rock Group.
Okay, so thank you, Senior. So this is from what? From control to non-control, isn't it? Okay. All right. So they are saying that Rock acquired what 70% investment in Doc for 2002 years ago. Its group policy, it is group policy to measure non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest at the date of acquisition was 800, and the fair value of Doc's net assets was 1,900. The goodwill has not impaired. So at the date of acquisition, what is the first thing that you have to look for? At the date of acquisition, what is the first thing that you have to look for?
The net asset.
Okay, do you have the net assets? Yeah, I'm sure we have the net
Yes.
assets.
Yeah,
Okay.
we have the net assets.
We have the NCI. So what do you have to look for?
Goodwill.
The goodwill. Okay. So the goodwill is very important because if you sell all your shares or part of your shares, the goodwill will also not be what? Will also not be in the books again. It means that you are losing everything concerning the company. The staff will no longer be your staff. Maybe you are having a goodwill because of the location and because of the staff, but since you have disposed your shareholding over there, you don't have control. It means that the strategic location and the expertise of the staff will now be transferred to the new owner. Okay, so let's come here. The first thing that we have to do is to calculate the goodwill. So calculation of goodwill. Okay, so we have the purchase consideration will count first. So the purchase consideration is 2,000. Am I correct? Okay. So the net assets that the parent is buying will be how much? What is the total net asset? It's 1,900, isn't it?
1,900, yeah.
Okay. And the NCA portion is what?
800.
So it means that the parent is paying for 1,100. Am I correct?
Yes.
So goodwill will be 900. Okay. So we have the goodwill already, and let's be moving on. Okay. We have the goodwill. Let's be moving on. Okay. Let's now come here. Rock has made a disposal of shares
that
in Doc.
is
Is someone talking to me?
I was like, that means goodwill at acquisition won't change or what? Because were we solving for goodwill at acquisition?
They say goodwill has not been impaired. So it means that the goodwill at acquisition will still be the same as the goodwill at reporting.
At acquisition. At disposal. Okay, reporting.
Okay. All right. So Rock has made a disposal of shares in Doc. The net assets of Doc recorded in the consolidated financial statement at the date of disposal were what? Were 2,400. Rock pays a tax at 30%. Okay. Rock has disposed all of its shares in Doc for sale proceeds of 3,000. Okay, let's come here. At the date of the sale, what is the net asset?
$2,400.
Okay. So the question now is the total net asset will now be 2,400 plus what? 900. Am I correct? it will be 2,400 plus the goodwill. The goodwill is not part of the net asset. They are only giving the net asset of the subsidiary, excluding the goodwill. So that would be 2,400 plus 900. Are we okay with that?
Yes.
Okay.
I will be 900.
The 900 is the goodwill. Is the goodwill that we have. Are you okay?
Yes.
Okay. So the goodwill is not part of the net asset that they are giving to you. They are only giving you the fair value of the physical asset. So the total value of the net asset will now be 2,400, which is the value of the physical net asset at disposal plus the value of the goodwill. The goodwill has not impaired, so it will still be the 900. So we now be having 3,300. But the question is, this 3,300 is for the total company, which is being shared between NCI and the parents. So you ask yourself, what is the NCI portion of the net assets? Out of the 3,300, what would be the NCI portion? They are not using proportionate method that you'll be using 30% of that one. No, they are not using proportionate method. They are using a full goodwill method. So you can't use 30% of the 3,300. But there is a way that you can calculate the NCI. What increases the NCI value? NCI at acquisition. What will increase the NCI at acquisition? What increases NCI at acquisition?
Profit.
Is a share of the profit, isn't it? All right.
Yeah.
Our net asset at acquisition was what?
1,900.
And the net
1,900.
asset at disposal now is what?
2,400.
2,400.
What is the difference?
500.
That this difference represents what?
Profit. Post-acquisition profit.
That is the post-acquisition profit. The only thing that can increase the net asset is the retained earnings. The share capital will still be the same. Everything will be the same. But the only thing that will increase the net asset is the reserves. So the difference between them will be the post-acquisition profit. So let's find the NCI at disposal. So NCI at disposal. NCI at disposal. Okay, that will give us the fair value at acquisition. Fair value at acquisition. That will give us 800. Then we have the share of the post-acquisition profits. The share of the post-acquisition profits. So share of post-acquisition profits. So that will be 0.3 multiplied by 2,400 minus 1,900. What are we getting? Okay, 150. Okay, so the total will now be 950, isn't it? Okay. So what are they asking us? They're asking us to find the gain in the individual statement of what? Of ROC. So in the individual statement of ROC, the investment will be recorded at cost. So let's look at it one by one. The first one, in the individual statement, in a separate financial statement of ROC, separate financial statement of ROC, the investment will be recognized at cost. So separate financial statement of ROC, the investment will be recognized at cost. So the proceeds will be 3,000. Okay. In the separate financial statement, the investment is always recognized at cost. So what is the cost? The cost is the fair value that the purchase consideration, the amount that they are paying for the shares. So that will be 2,000. So this particular one will be, so we now look at the cost of the investment, because in their individual financial statement, this will be recognized at the cost. So the gain will now be 1,000, isn't it? Okay. And they will pay tax of 30% on this one. So we have 1,000, and that will give us 300. Then we have 700. So if the question asks you to find the gain in the individual financial statement, just take the proceeds, just take the proceeds, just take the proceeds and subtract the cost. The cost is the investment, the amount that you are having in the investment. So, or how much did you buy the shares? That is the cost of the investment. So you just subtract it because in the individual financial statement, the investment will always be recognized at cost. So the gain will be 1,000 and they are going to pay a tax of what? 30% on that one. But let's come to the consolidated financial statement. The consolidated financial statement is what we have done. Okay. So we have the process. We have the process of 3,000. Okay. We have the process of 3,000. Then we are going to be having the NCI because we are selling all the shares. So NCI will be 950. Let's add. Or someone can decide to subtract the NCI from the total net assets. So you now have the net assets. So this will be 3950. So you now have the net assets, which will be 2,400 plus 900. Okay, and that will give you 3,300. What will be the difference? It will be 650, isn't it? Okay.
Yes.
They say excluding tax, isn't it? Okay. So the tax, what we do is that we don't do tax at the group level. You can see that if you're preparing statement of profit or loss, you just add the profit, you just add the tax from the individual separate financial statement. Is that not what we do? You just take the tax for the two companies and add it together. We don't charge tax on the consolidated profit. We just add the individual what? Tax. So the tax that we are going to be putting over here will still be the tax in the individual financial statement of Rock. That will be 300. We don't charge tax at the group level. We just add the two taxes of the two entities and subtract it from the profit. That's what we do. So the tax element that will be coming here will still be the 300. So this will now be 350. That is a gain. Okay. They are saying that we should assume if something happens. So let's go to that assumption. Okay. Now assume that Rock disposed of half of its shares in Dog for 1,500 and that the remaining holding had a fair value of 1,300 at the date of disposal. Calculate the profit or loss on disposal. That will be recorded in the consolidated statement of financial position or of profit or loss, ignoring any tax effects. Explain how the residual holding will subsequently be accounted for in the consolidated financial statement of this particular one. All right. So what we have done is that they have sold all. Okay. But now let's come and say that they have sold only parts. So let's look at the gain on disposal. Even if they sold half, it will still be a loss of control. So let's look at the gain on disposal. So we look at the proceeds. The proceeds was how much? Okay, the proceeds were 1,500 and the interest return. So the proceeds will be 1,500. The interest return was 1,300. NCL will still be the same value. The only thing that is changing over here is that they are not selling all. So the NCL will still be the same thing. So NCL will still be 950. So let's add, and our net asset will still be the same value. So the net asset will still be 1,900. Or no, please, it will be 2,400. 2,400 plus 900. That will be 3,300. What is the difference? I'm getting 450.
150.
Okay. So that will be the gain. That's how we go about it. The subsequent treatment of the interest return will either be a financial instrument if the percentage holding is less than 20%. But if it is above 20% or is 20% and above but less than 50%, that will be treated as investment in associates. So what will be the remaining holding? They are selling half of 70. So what will be the remaining?
35.
Okay, so this 35 will be accounted for as what?
Investment in associates.
Okay, investment in associates, yeah. So any profit or loss from the associate will be shared. So if they have profit, the parent will take 35% of the profits and that is it. So that is the subsequent measurement. It will either be a financial instrument if it is less than 20%, or it will either be investment in associates if it is more than 20 but less than 50%. All right. Let's look at maybe let's see whether we can pick a major question and see. So this is not. I wanted us to look at a situation where a parent will only sell portion and they will have this one. So you can look at question 3. You can see that the okay. You can see what is going to happen over here. They have 90. They have 90 and they are selling 15%. So they are selling 15%. So what you do is that you just find your net asset, here where and the goodwill was this. It's a group policy to value this and this. Okay. So on that date, it sold 15% for 100,000, and the date of the sale, the net assets were 650,000, and the goodwill was 150,000. It is a group policy to measure NCI at fair value. So you just add these two, 650 plus the what? The 150, because the net asset, we are using fair value for the NCI. So that will be full goodwill method. So the total net asset will be the physical asset plus the what? This one. So you just find 15% of 800,000. That is the portion that the parent will be transferring. You compare with this and see whether it will be a negative or positive, but whatever will be the difference will be sent to other components of equity. So this one, they haven't given you the NCI, but they have given you the net assets at the date of what? The sale. So you just add it to the goodwill at the date of the sale. Then you find the portion that the parent is selling and compare with the amount that they are receiving. So demonstrate how this would differ if group policy was to measure NCI at the proportionate of net assets instead. So this one, what will happen is that we are going to be calculating the 15% on only the 650,000, because NCI will not be having a share of the goodwill, which is the 150,000. So that is all about that question. Let's pick a practical question, a more detailed question. Then we see how we can go about it. Okay, let's look at the question 5, profit or loss. Then we come to let's look at profit or loss. Then we come to financial position. So financial position, maybe we pick the question 3 or something. Okay. So now, Augustine, are you there?
Yes, I'm here.
Okay. Try. Let's see. We can pick. Let's see whether we can solve 2 questions, because we have 2 hours remaining. So let's see if we can use 1 hour for this one. So question 5.
Okay. The statement of corporation income for 3 entities for the year ended 30 September 2017 are presented below.
Okay.
So we have
You don't have to wait. Let's assume that we are in the exam hall. What will be the first thing that you will do?
We put up our structure.
Yeah, you
We
put
write
you put a structure there by you know that the parent will be the SOT. So you just put your structure there. So you have the SOT group, consolidated statements of profit or loss. Okay, I'm not here to write that in full. So let's have the revenue here. So we have the revenue. Okay, so let's take the revenue for SOT. Let's put their figures before we go and determine who is the subsidiary and who is not the subsidiary. So what is their revenue?
6,720.
Okay, 6720. So 6720. So we have their cost of sales.
1,000.
Okay. So the next item will be gross profits, which we don't do anything. We just put it here because this one, if you do your working very well, you get your gross profits. So let's look at the other items. Admin expenses. So let's have admin
3,120.
3,120. Then we have the distribution cost,
760.
760. The next item is what?
Investment income.
So the investment income.
So the administration expenses is 760.
Administration is 760.
Yes.
Okay. Okay.
Sorry.
Hey, you have picked the gross profits. Okay.
Yeah.
And then it's 800.
Okay. So 760, 800. So we have 760 and the 800. And this will be 80. Okay. So the next item is what? Finance cost. So finance cost will be 360. Then we have profit before tax. Then we go to the tax figure. So the income tax is 400 for them. Okay. So we have profit for the year.
A hand time.
So we have profit for the year. Okay. Profit for the year. Then we have other comprehensive income. So we have gain, actuarial gain or something, I'm sure. Okay, actuarial gain. Actuarial gain, then we have. Okay. I'll give you one thing. Then we have the tax effects. I'll give you 30. Okay. So we can now start looking for who is a subsidiary and for how long they have been a subsidiary and what is going to happen. So let's scan through. So you can see that the footnote 1, we can see the SOT acquired what? 160 of the what? Of the shares of BP on first this one. So let's see whether this question is disposal. So you have to be very careful with the disposal issues. Okay. So let's scan through and see whether there's any issues of disposal relating to BP. Okay, they have acquired a BP on 1st May 2017. Okay, and the year that we are preparing the financial statement is 1st September 2017. So they acquired them 1st May 2017 to 30th September 2017. How many months is that?
5.
That will be 5 months. So that will be 5 months. So there was no, let's see whether that will give them control. Okay, let's see, that will give them control. So the total number of shares that they have is 200,000 and they are buying 160,000. So 160 divided by 200 times, okay, 100, that will give them
That's 80%.
Okay, so we are going to consolidate them for only 5 months. So let's go there. We do plus 5/12 times the profit or loss items of the BP. So their revenue is 640. Their revenue times 6. Hey, I've forgotten the figure. It's
6240.
Okay, 6240. Okay, their cost of sales will also be 5/12 times. What is their cost of sales?
336.
Okay, 3360. So 3360 plus 5/12 times their admin expenses.
740.
740. Distribution cost will be 5/12 times.
700.
Do you have any investment income for them?
No.
Okay. So what about the finance cost?
240.
So 5/12 times 240.
Hello, Senior Linus.
Yes, please.
Senior Linus, please. The reserves of PB at first were, so it means he acquired it in May.
Yeah, 1st May.
Yeah, so I think won't it be May, June, July, August, September, October, November, December?
No, we are preparing the statement for 30th September. Check the reporting date.
Oh, okay, boss, thank you.
All right.
Pardon me.
Okay, don't worry. Their tax expense is what?
$360.
Okay. Do they have any gain on do they have any actual gain? Yes.
No.
Okay. And they don't have any tax effect too. Okay. They don't have any
No.
tax effect too. Okay. So let's deal with the footnote 1 now, because this one there's no disposal of them. So what they are saying is that okay, their results of BP at this one were what? So the results that they are talking about is just what? The retained earnings and any other reserves that was there at the date of acquisition. So they are giving you this to determine the net assets. So they are saying that a year-end impairment review indicated that goodwill on acquisition of BP was impaired by 10%. Before you can find the impairment on the goodwill, you have to find the goodwill. So we have to find the goodwill for this particular one, we have to find a goodwill arising from the BP. Okay, they haven't given you any. Okay, they have given you issues on the fair value adjustments. Okay, but let's look at the net assets. Let's calculate the goodwill. Let's do the workings now. This one too, you have to show the group structure. You have to show group structure, but we don't do net asset as reporting and those things for profit or loss. The only thing that you can do is the goodwill calculation. So let's come to, okay, let me come here and have the workings.
Hello, sir.
Yes,
Please, I want to get you clear. You said when it comes to P&L, you don't do net assets for them. You only start from goodwill, group structure and goodwill. Is that what you said? I want to get it right.
goodwill cry, you can only do the goodwill if they are asking for the impairment on the goodwill. But sometimes
Okay.
the question can give you the impairment of the goodwill straightforward. So it means that there's no need for you to calculate goodwill.
So that's if I get you right, the group structure, then NCI.
We don't do NCI too. NCI, where are you taking it from?
Okay.
You only do NCI and those things for statement of financial position because you want to know the figure that you send to the statement of financial position. This one, we are only interested in the profits. So the workings that you do is the group structure. The question might ask you to determine the goodwill. So you do goodwill. But if you are giving the impairment of the goodwill straightforward, you don't do goodwill too. So this one, the only workings that you do is maybe the additional depreciation arising from fair value movements, provision for unrealized profit, and any other issues. But those major workings that you do for statement of financial position, you don't have to do them here because they are not needed. They are not needed unless the question asks you. So let's look at the goodwill. The first one is the goodwill. We all know how to do the group structure, so there's no problem with that. So goodwill calculation. Okay. Let's look at the purchase consideration. How much are they paying for the shares? How much are they paying? 2.8 million.
8 million.
Okay. So they are paying 2.8 million cash. So 2,800 cash. Okay. So the only thing that you do is that you can come and add the NCI. NCI was not given to you. So you have to determine the NCI yourself. So you look at net asset at acquisition. Okay. So net asset at acquisition, you have your share capital. Okay. What will be the value of the share capital? Someone should look at the question and give me. What is the value of the share capital at acquisition? What will be the value?
No, 2,800. 2
No.
million.
It will be what?
200,000.
No.
800.
No, it's the 2,800,000 is the amount that they are paying. Read the question very well. The SOT acquired 160,000 of the 200,000 shares, which is issued at 1 cedi share capital of BP on 1st May 2017 for. So it means that they are paying the 2.8 million for the 160. But the total number of shares that they have at that date is 200,000, and one share is what? 1 cedi. So the share capital is 200,000 as someone has mentioned. Okay. So the share capital will be 200,000. So we have 200 here. That is the value of the equity capital. Okay. What will be the reserves? What is the reserves at that date? The reserves of BP at the date of acquisition was what?
0, 50,000.
2050.
Okay.
2,050,000.
Okay. So this one, what do we have to do? We have to do fair value adjustments. Okay. So the fair value adjustments, these values that you have calculated is based on their net book value. But IFRS 10 and IFRS 3, they are saying that the date of acquisition, the asset of the subsidiary must be what?
Yeah.
Fair valued. So these are valued based on the book value. So let's look at, is there any changes in the fair value of the asset? at the date of acquisition. They are telling us something over here. Okay. So the fair value of the net assets acquired was the same as the book value with the exception of property, plant, and equipment, which was higher by what? 960,000. So this one, is it increase or decrease?
Increase.
This will be increase. So at the date of acquisition, the net asset will also increase, isn't it? So we have P over here to be 960. Okay. Is it going to be 960 or 960? Okay. The uplift in fair value related to a depreciation property with estimated total useful life of 50 years. Okay. So we acquired them on 1st May, isn't it? Okay. So
Yes.
if we are recognizing this particular gain, this particular increase, when are we recognizing this particular increase? At the date of acquisition, isn't it?
Yeah.
But when are we
Yes.
preparing the financial statements now?
September.
Okay, would the value still be 960 at the reporting date?
Oh, no.
No, it will reduce by 5 months, isn't it? Okay, so we find the additional depreciation on that particular value there. So let's look at additional depreciation on the fair value. So additional depreciation on the fair value. So that would be 960 divided by 50 times 5 over 12. Okay, they have given us the 50 years there. Okay. Okay, it's 10 years rather. Okay, let me see. The uplift in the related to depreciable value with the estimated total useful life of 50 years. At the date of acquisition, BP had owned and used this property for 10 years. So what will be the remaining useful life?
40.
40.
40.
That is nice. So at the date of acquisition, BP had owned and used this property for 10 years. So at the date of acquisition, they have already used 10 years out of this one. So the remaining will be 40 years now. These people, they are not serious. Why can't you give me the 40 straightforward? Okay. So they have used, at the date of acquisition, BP had owned and used this property for 10 years. The group policy is to charge depreciation on buildings to administrative expenses on monthly basis from the date of acquisition to the date of disposal. So what will be the depreciation there?
I had 10.
Okay, let's confirm. 960 divided by 40 times
Yeah,
5
it's 10.
by 12. Okay, so that will be an increase to administrative expenses, isn't it? So we add 10 over here. That depreciation should have been taken from profit, but we haven't taken it. Okay, so let's now come here and deal with our goodwill. So we are done with the footnote 2. That is not the B. We are done with that one. There is nothing that we have to do again. So let's come to the goodwill calculation and also the NCI. Okay. Okay. So what will be the value of the net assets now?
3210.
Okay. Okay. That will be 3 to 10.
10.
Okay. But what will be the NCI? NCI will be 20% times 3 to 10 because NCI is measured on what? At a proportionate basis. So the
Okay.
company is having 80%. So NCI will be 20%. So what will be the NCI value? 0.2 times that one. I'm having 642. Is that correct?
Yes, senior.
Okay. So what will be the total here? I'm having 3442.
All right.
Okay. Against 3210. What will be the goodwill?
232.
Okay. There will be an impairment of what? The goodwill has impaired by 10%. So that will give us 23.2. Am I correct?
Yes.
Okay. The goodwill, don't go and say you are doing it on monthly basis. The 10% is purely relating to post-acquisition period. Are you okay? So the 10% is purely relating to post-acquisition period. It's not based on a yearly basis. Okay. So let's come here. The goodwill, the impairment of goodwill losses to administrative expenses. So the impairment will go to administrative expenses. So that will be plus 23.2. Okay, so we are done with the first two notes now. So we are done with the first two notes. Let's come to the C. Yeah. So Augustine, take the C for us.
C. So disposed of 40,000 1 cedi ordinary shares of UV on July 1, 2017 for 960,000. SOT had acquired 75,000 of the 100,000 1 cedi issued ordinary share capital of UV for 980,000 on 1 November 2014, when the balance on reserves was 1,020,000. The fair value of the shareholding retained at July 1, 2017 was 792,000. There was no evidence of goodwill having been impaired since the date of acquisition. The reserves of UV at October 1, 2016 were 1,300,000.
How many lines is that? It's 6, isn't it?
Yes.
But there are a lot of things in that 6 lines which can even take 30 minutes of your time. Okay. In this particular 6 lines, you are going to determine when the UV was acquired. When was UV acquired?
July 1, 2017.
No, please.
November 24.
Augustine, you are the one who read the question on. SOT had acquired 75%, 75,000 of the 100,000 shares issued ordinary share capital of UV for 980,000 on 1st November 2014. So it means that we have acquired them like maybe 3 or 4 years ago, isn't it? Okay. Yes. But when did we dispose of our shares?
1st July 2017.
Okay. What you have to ask yourself is that, okay, you have acquired what, 75,000 out of what? 75,000 out of 100,000. What will be the percentage holding? That will be 75%, isn't it?
Yeah.
Okay.
Yes.
Now you have sold what? 40,000. You first have to ask yourself, 40,000, what is the percentage of the one that you are selling? So that will still be 40 over the 100,000, because the 40,000 you are selling is out of what? The 100,000 shares. It will still be pro rata on 100,000 shares. Okay, so you have 75,000 out of the 100. You are selling 400. Those people who will be buying the 400, they will find their percentage holding on total number of shares. So that you are selling 40%. What is happening? You will be having what, 35%, isn't it?
Yes.
Okay,
Yes.
It means that on 1st July, you will be losing control of what? UV. But from November 2014 up to 1st July, you have control, isn't it?
Yes.
Yes.
Okay. But this reporting year starts from when? This particular reporting year starts from when? Start from 1st October.
July.
This reporting year will start from 1st October.
October.
Okay. 2016, isn't it?
Yes.
To 30th September 2017. Okay. So the question is, this particular year, this reporting year, how many months do you have control over UV?
10
How many
months.
months? Is it going to be 10 months? Okay, you lose control
sorry,
from
9,
July.
9, 9.
Okay, July, August, September, isn't it?
9 months.
Okay, So that will be 9 months. So you consolidate them for 9 months. It means that you have a control over them 9 months for this particular year before you dispose your shareholding to lose control. So you consolidate their figures for 9 months. So we go there and consolidate them for 9 months because that 9 months we have control over them. So we have a 9-month share of the profits as what? As a parent. So let's go and consolidate them for 9 months. So we take their figures also and have plus 9/12 times their revenue figure plus 9/12 times all their figures. Okay, their revenue is how much?
Say 5280.
5280. Okay, their cost of sales is what?
Yeah. Cost of sales is 2880.
2880. Okay, their admin expenses.
Admin expenses is 650.
650. Distribution is how much?
Distribution is 550.
550. Do they have investment income?
No investment income.
Finance cost is what?
Finance cost is 216.
216. Okay, their tax.
Yeah, profit before tax.
Now the profit before tax, we don't do anything because if you do your calculation very well, you get that figure.
Yeah, their income tax for the year is 300.
Okay. Do they have any other comprehensive income?
No other comprehensive income
Okay.
except actual based on defined benefit pension plan.
They have some for that one.
Yes.
They have 40, isn't it?
Yes.
Okay. So that one we assume that is also for a full year. So we do plus 9/12 times 125 or 40. Okay. Their tax effect is what? 15. Is that correct?
Yes, their tax
okay.
effect.
Okay. All right. That's nice. So we are still on the C. Okay. So we know the consolidation right now. But since we are disposing them of, it means that we have to find a gain on the disposal, isn't it? We are losing the control. So we have to find a gain on the disposal. How do we find a gain? We find the proceeds, we find the net asset at the date of disposal, we find the interest, the fair value of the interest return, then we find the NCA also and know how we go about it. Okay, let's now come here. What is so we have to find a goodwill. The first thing that we have to do is the goodwill because the goodwill will be coming over here and the goodwill too will be losing it. So let's find the goodwill on them first. So the second one is we have to calculate the goodwill on their acquisition too. So the purchase consideration in this question is what? For them is what? What is their purchase consideration? How much are they paying for the shares? Is it 960?
It's 960.
It's 980. They are selling for 960, but they bought it at 980. So the 40,000 that they are selling is the 960, but they acquired the 75,000 for 980. Ziani, can you see that?
Yes, sir.
Okay. So the purchase consideration is 980. So let's now ask ourselves, what is the net asset and what is the NCI? So NCI will come here, then we come to the net assets. The net asset will always start with the share capital. Okay. The share capital, which is the ordinary share capital. So the same principle that we are using, they have 100,000 shares and each share is 1 cedi. So it means that the value of the equity capital will be 100, which will be 100,000. the assumption is that there will not be any new issue of shares because we want the companies to have the same percentage holding. If it is 75%, the number of shares that you have before having 75%, the shares to be the same, and you'll be having the same number of shares. But if they should issue a new shares, it is going to dilute their percentage holding. So we want the percentage holding to be the same. So we assume that the shares at acquisition is the same as the shares at reporting. So the value of their share capital will be 100 cedis. Let's count to their reserves. What is the reserves that the question is saying there? How much was their reserves at the date of acquisition? Okay, so when the balance on reserves was what? When the balance on reserves was what? 1020.
1020.
Okay, the balance on reserve will be 1020. Okay, let's come and see whether there is any fair value adjustment on their net assets. They were not saying anything over there. Okay, they are not saying anything about the fair value adjustments. Okay, so there's no fair value adjustment over here, but let's see what they are doing over here. Okay, let's see what they are doing over here. There is no fair value adjustment over here, but are we giving the value of the NCI?
No, we're rather giving the retained interest.
Okay, so what do we do? Since we don't have the NCI, what do we do? What method are we going to be assuming? What method are we going to be using? We use the
Is the
proportionate.
fair value?
Proportionate.
Okay. The question says that the group policy is to value the NCI through proportionate. So if you are not giving the NCI, you assume that the NCI will be a proportionate one. So our net assets will be 1120. Am I correct?
Yes.
Okay. NCI will be 0.25 times 1120. What are we having? I'm sure we know how we got the 25% because the parent is having 75%. We have calculated that, and the NCI will be 280 plus 980 minus 1120. Goodwill will be 140. Can someone confirm that?
Confirm.
Okay. Let's now look at gain on disposal. Okay. The gain on disposal, we start with the process, and the process was 960. So interest return, which the value was given to us. So what was the interest return? Okay, this question, if you
790.
if you know that you can adjust this one, you can move on to the next footnote and deal with them before you come to this one. Okay, there are other issues that you can just deal with them and move on. But this one, since we are solving the question, let's deal with this one. So that will be the interest return is 792. Okay. 792. Okay. So what we do is that we have to find the NCI and add. We are going to find the NCI. Then we are going to be having our net assets at disposal. Then we add our goodwill. There is no impairment of the goodwill. So the goodwill will still be 140. So we add 140 here. But we are going to look at the NCI and then the net assets. But they have given us information to get that particular one. All right. So the fair value of the shareholding return at July was 792. There was no evidence of goodwill having been impaired since the date of what? Acquisition. Okay. The results of UV at October 2016 were what? 1,300, isn't it? Okay.
Yeah.
Do you know the reason why they have given you the results?
Is it not for goodwill impairment?
No. There was no evidence of goodwill having been impaired since the date of acquisition. There's a reason why they have given you the results at the beginning of the year. At the date of
Okay.
disposal, we have to calculate the net asset, isn't it?
Yes.
Okay. What will be the net asset? The net asset will only be the share capital plus the retained earnings at the date of disposal. Okay. So the net asset will still be the net asset will now be, let me do it one by one. So let me expand the net asset calculation here so that we can look at it very well. So the net asset will now be the share capital. The share capital will still be the 100 because the value of the shares will still be the same. There will not be any new shares. Then we now have reserves. Okay, this will all be at the date of disposal. When was the disposal done?
July 17.
Okay, 1st July. But the results that we have, they have given us reserve at the beginning of this year, isn't it?
Yes.
Okay, so the results at the beginning of this year is 1,300. So it means that we need just 9 months of the profit and add it to this one to now have the results at the date of what? Disposal. Because this is given to us at the beginning of this year. So we have done 9 months before what? Selling them off. We have done 9 months before selling them off. So we just need the results for what? This particular 9 months. Then if you add it, then you now have the results at what? At disposal. So we just calculate the 9 months of the results. What is the results? Let's go and look for their results. What is the total results for them? What is the total results for them?
709.
Okay, the total results is just the total comprehensive income. Okay, that is 709. We find 9 months of it. So our results will be 1,300, which is the one at the beginning. We add the number of months that we have done before disposing them. So plus 9 over 12 times 709. What are we getting?
531.
531. So add it to
1832.
9 over 12 times 709. I'm getting 531.75. Okay, I'm getting 531.75 plus 1,300. I'm getting 1831.75, isn't it?
Yes.
Okay, so we are running it to, okay, this one, since we are keeping 3 zeros, isn't it?
Yes.
Okay, so let's make it 1832. Okay. Okay, so what do we do now? We add a goodwill, isn't it? The goodwill will be 140. So we add a 140. Okay, we add a 140. But the question now is, what will be the NCI at this date? What will be the NCI at this date? The NCI, what are we using? We are using proportionate method, isn't it? We are using proportionate method for the NCI. So what you have to do is, another way of calculating your NCI is, you look at your results at disposal, then you compare with your results at acquisition. So minus 10,320. That will give you the post-acquisition profits. you find the NCA share of it and add it to the NCA, or you find the NCA share on the net asset at acquisition without the goodwill, because NCA is not having the share of the goodwill. So you can have the 1832 minus 1020 multiplied by 0.25. Then you add it to 280. You'll be having 483. Or you can just do 0.25 multiplied by the net asset at reporting, which will be 1932, because NCA is calculated on proportionate basis. NCA is calculated on proportionate basis. So what are you having? 0.25 times 932. I'm having 483. Okay, 792 plus 960. So I'm having 2235. Okay. Then we have 100 plus 1832 plus 140. So I'm having 272 minus 2235. The gain is 163. I'm having 163 as the gain.
Confirmed.
Okay. So this particular gain, you can show it as a line item.
Once more. It can make it indeed. So the first we found was a goodwill first, then gain on disposal.
We have share capital 100. The results are the date of the disposal. That we have the one at the beginning, we add the 9 months that we have done before we dispose, because we have done 9 months. So that will be 1832. Then we now have goodwill as 140. Then we add all of them. If we add all of them, then we have the 2072. Then we subtract from the 2235. Then we have the 163 as the gain on disposal.
Okay.
All right. So that particular gain, you can show it as a line item, but since we don't have space, you can add it to 163 as an investment income. But you have to show it as a line item in the statement of profit or loss. Gain on disposal of subsidiary. Gain on disposal of subsidiary. What is going to happen now? What is going to happen now? You see that the remaining 35% will be seen as what? Associate, isn't it?
Yes.
Okay. So what we do now is you will now show share of associate profits. Where can I write that one?
You see, madam.
Let me write share of associate profits. Okay. They have been associate for how many months?
3 months.
So you just find the share of the associate profits. So let's go and take their profits. We take only their profits. Okay. That will be 684. You also come to other comprehensive income and have the share of the associate comprehensive income. But we only show the profits first. So that will be 3/12 times 7, 3/12 times 684. What are we getting? Okay, I'm having 171. That is not a problem. But the share of the associate profit should also be shown as a line item. But since we don't have information on that one, that is why we didn't show them. So that is the C part. The C part is the major problem for this particular question. Is how to determine the net asset at reporting. That is very simple. They have given you the results. You know that net asset is a share capital plus the what? The results. The net asset is just the shareholders fund. So the shareholders fund is just their share capital, their share premium, their results, and any other share related issues. So you have the share capital, which will still be 100,000. But what is your results? What is your results at the date of reporting? They have given you the results at the beginning. How many months have you done before disposing them? 9 months. So if you add 9 months to it, then you now have your total results at the date of the disposal, which is 1st July. Then you calculate your goodwill. There's no impairment of the goodwill. Then you just find the NCR portion, take it from the total assets. Then you take the interest that you are returning, because the interest that you are returning is part of the net asset. Then you subtract from the money that you are receiving, which is 960. Let's come to the D. So now guess now the D.
PB paid a dividend of 100,000 on September 1, 2017, and SOTI has recorded its share in investment income.
Who is paying the dividend? Is the associate, isn't it?
Yes.
Okay. The parent is the owner of the associate, isn't it? Isn't it?
Yes.
Okay.
Yes.
Whenever a company pays dividend to its owners, where would the dividend be treated? Whenever a company pays dividend to its owners, in which of the statements that a dividend will be reported, will be treated? Is it going to be profit or loss, statement of changes in equity, or statement of financial position? Where would the dividend be treated? Dividend paid to the owners.
P&L.
Hey, dividend paid to owners. Okay, you have forgotten. Okay, you are now in CL, so you have forgotten about the preparation of final accounts. Okay, in statement of changes in equity, we have the share capital. Statement of changes in equity is the item, is the statement relating to the issues relating to the owners. So their share capital will be there, the profits for the year will be there, and the dividend paid to them will also be there. So when a subsidiary pays dividend, the dividend will be treated in a statement of changes in equity because they are paying the dividend to their owners, which the parent is part of them. So this dividend payment supposed not to count to profit or loss. The parent will still show it as investment income in their statement of changes in equity, not profit or loss. So let's find the percentage holding that the parent is having. The parent is having 80%, is that correct? Of BP. The parent is having 80% of BP. Okay, that will be 160 divided by 200 times 100. That will give us 80%. Okay. So the dividend payment now will be, the parent will have 80% of each share. 80% of 100 is what?
80.
Okay. What is the investment income for the parents? If you look at the statement of changes,
80.
it's 80. So that particular one is just the share of their dividend from that one. So you remove the 80. The share of the dividend will go to statement of changes in equity, not profit or loss. So you go and remove it. That is for that particular one. Okay. So you go and remove that one. Then let's look at the another one. The rest of the footnotes are not issues that you have to bother about. Okay. Let's come to E.
Okay. E. SOT holds several investments as fair value through other comprehensive income and account for this in accordance with IFRS and financial instrument gain on subsequent financial instruments. Gain on subsequent measurement of 46,000 occurred in the year. The financial controller, however, is unsure how this should be presented within the statement of comprehensive income, and so has yet to include it.
Okay, this particular transaction, where are they going to put it? This again, through other comprehensive income. So we go and add it to what? Their other comprehensive income, isn't it? Okay, so that is a gain on a financial asset through other comprehensive income. So you just say this is actuarial gain, so you can't add. Okay, so you have gain on financial asset or fair value gain. Okay, you just say fair value gain. Fair value gain of 46. That is what they are saying. The gain will be recognized in other comprehensive income because the instrument is classified through other comprehensive income. Let's move on.
Okay, so F. SOT also disposed of an investment held at fair value through other comprehensive income. That instrument during the year 30 September 2017 for 630,000, when the carrying value of the investment was 580,000. The gain on disposal of 50,000 is included in the administrative expense. Previously recognized gains associated with the investment of 40,000 still remain in other reserves.
Okay. Okay. So SO also dispose of an investment held as fair value through other comprehensive income debt instruments during the year to 31st September for 630, when the carrying value of the investment was what? 580. So the gain on disposal of 50,000 is included in administrative expenses. So what do you have to do? The gain on disposal, what do you do? You can decide to show it as a line item, or you can write it against maybe any other. So they are written that particular one as against administrative expenses. So you can also go and show the gain of 50,000 as a line item, then you go and add it back to the administrative expenses. It will be having the same effects. Okay, so you can go to administrative expenses, then you can go there and add the 50,000 back because it was subtracted. It's a gain against expense. So you now come and show the fair value gain as a line item of 50,000. You can see that they are all going to be having the same effects. Okay, so you can leave it in administrative expenses. Nobody is going to do anything. Okay. Previously recognized gains associated with these investments of 40,000 still remain in other reserves. Okay, this is what they are selling, a debt instrument, isn't it?
Yes.
Okay, and I've said something about debt instruments, the disposal of debt instrument, the time that we were doing financial instruments. I've said something about debt instrument and also equity instruments. I've said that if there's a disposal of debt instruments, all the gains that we have previously recognized in other reserves will be recycled to profit or loss or retained earnings. Because you have sold the instrument, you will now recognize the gain. So the 40 that is included in other reserves will now be reclassified to profit or loss. So you go to other reserves and you remove the 40 from that place and now bring it to what? To profit or loss. So you are going to be doing a transfer from other reserves to retained earnings. That's what we are talking about. So you reclassify all of these ones to other reserves. You reclassify them to retained earnings, which is the same as profit or loss. So you can go and write a reclassification of 40 to the retained earnings or the profit. So you can add this one here. You can add a 40 there, which is the reclassification of the gain. The gain has now actually been recognized, has now actually been realized. So you reclassify it to profit or loss. So you can, since we don't have space, I can decide to add it over there. Okay. So that's how we go about it. That's how we go.
Linus,
Yes, Ina.
so by way of revision, if it were an equity sort of investment,
We don't do it on equity. Equity will always be there with the company.
yeah,
Okay.
okay.
So the debt instrument, the idea is that you pay it, but equity will stay with the company forever. So you reclassify the 40 to the profit or loss. So if you are preparing statement of financial position, then you go and reduce your other reserves by 40. Or someone can also say that, okay, the other reserves is here. So the person will come and take the 40 here, but the 40 is not actually here. The 40 is in other reserves. Or someone can decide to bring the 40 here and still subtract the 40 again, because the 40 is not technically for this year. The 40 that we are recycling is not for this year. So you can't take it from what? From the other comprehensive income, because it's not for this year. It is in the other reserves balances. So someone can say you are going to remove that particular other reserves and bring it to other comprehensive income before you reclassify to profit or loss. So you can bring the 40 minus 40, that will be 0. Or you can just send it to profit or loss, and that is the end. Okay, that is all. Or someone can decide that, okay, since that will be a transfer from retain earnings to that one, let me just go and transfer from retain earnings. But you have to know that at the end of the day, the profit will be sent to retain earnings. So just bring the reclassification over here. Okay, but for the gain, you can leave it in administrative expenses because it's a reduction, or you can bring it out of the administrative expenses as a line item on each one. Okay, so assume that all income and gains for the 3 entities are paid evenly throughout the year. Ignore any further tax impact on investment held as fair value through other comprehensive income. So maybe if they give you a tax rate, you will see that the gain that you are having over here, the 416 gain over there, will be a tax issue. It will be a tax issue. So you calculate your deferred tax on it. Okay, because you're having a gain. So the tax base will automatically be lower than the carrying value, because the tax authority does not carry the investment at fair value. All right. So this is all about this question. We just have to put the figures together. Okay. But me, I will just show how do we share the profit. How do we share the profits? Okay. How do we share the profit? So let's look at the share of the profits. I will not add because we don't have time. Share of profits. So the share of profits, we are going to be having a parent holding. Then we have the NCI. Then we also have total comprehensive income. How do we share it? Total comprehensive income. So we look at the sharing. So we are going to have the parent holding, and then we have the NCI. Okay, the NCI, we always start sharing the profit from the NCI portion, because the total profit that we'll be having for the year, the parent portion will be part of it. The parent portion will be part of it. And the parent owned company will also be part, and the parent share of the subsidiary is also part. So if you know the portion of the NCI included in the total profits, the remaining one will be for the parents. Or you can also, if you know the total profits, you can also calculate the profit from the perspective of the parents. What is the parent own profit from the total profits? If you know the parent own, then it means that the remaining one will be for the NCI. Then you will be for the subsidiary. Then you just find the NCI portion of it. I have showed that one yesterday in the financial reporting class, but we don't have time, and that is not what we are here to do. You can see that the NCI is going to be for 2 companies, isn't it? We are going to be having NCI for 2 companies. One will be 20% and one will be 25% for 9 months. Are we okay? All right. Let's come to the first one. The first one we are going to be having a profit of 5 months, because NCA will have only 5 months share of the profits. So let's go to the profit of the BP. What is the profit of BP for the year? It's 840. Okay. So that profit we are doing only, so we have 840, 5/12 over 840. Then we now ask ourselves, what are the post-acquisition adjustment that we have to do? What are the post-acquisition adjustment that was done on BP? What are the post-acquisition adjustment? The first one is what? Is the additional depreciation. So if you are doing net assets, it means that the depreciation of 10, the depreciation of 10, the depreciation of 10 should have been subtracted from the net assets. The net assets at reporting. And this is the profit included in the net asset at reporting. So we subtract the 10. The other one will be the impairment. The other one will be the impairment. The impairment is relating to what? To the subsidiaries goodwill. So we have impairment from that side also. So I'm sure we can get those one here. So we have 10 and the impairment is 23.2. So we are going to be having impairment of 23.2. So we are going to be having impairment of 23.2. So you find 5/12 times 40 first. That will be the post-acquisition profit. Then these figures should have been taken away from the net asset table at reporting. So we just take it from the post-acquisition profit. These are the post-acquisition adjustments. Okay. Then let's see whether we have any other adjustments relating to BP. Any other post-acquisition adjustments. We have the impairment, we have the depreciation, and let's see what will happen again. The dividend will not come because dividend is not an item that will come there. So there is no other issues there. So you have all of this multiplied by 0.2. So you have 5/12 times 840. Then you now subtract 10, 23.2 from that. That will give you the post-acquisition profit. Then NCA will have what? 20%. Then plus 0.25, which is the NCF for UV, because they are going to have a share of 9 months worth profit, and we have consolidated that particular 9 months. So we also have 9/12 times the profit for the UV. So profit for UV. So the profit for UV, what is the profit for UV? That is 709. No, it's 684. That is profit. So we have the 684. We have the 684. So the 684. Is there any post-acquisition adjustment relating to UV? No. There is no impairment, there is no fair value adjustment, and there's nothing like that. So you just have the 9 months of 684. Then you add the 2. If you add the 2, that will give you the NCI share. So you have the NCI share. Then you have the total profit that you have calculated minus the NCI figure. And that will give you the parent shareholding. If you count to this particular one too, you always find the NCI what? Holding. So let's assume that the NCI over here is A. So you have your A, because the total comprehensive income will be the profit plus the other comprehensive income issues. So you have your NCI figure from the profit that you have over here. So the NCI share of the profit over here, you just add your comprehensive income to it. That will be the NCI total share of the comprehensive income. So you now ask yourself, do I have any other comprehensive income relating to the first subsidiary, which is 5 months? No, I don't have any. But I have only these people, which is UV, that will be for 9 months. So I will just come here and have plus 9/12 times 25, because that will be post. It is 40 minus the 15 tax. So you take the tax from it before you have. So this will give you your NCI share of the total comprehensive income. Then you now take the total comprehensive income and subtract the NCI share of it. That will give you the portion of the parents. But if you are giving statement of profit or loss, you cannot share. You can just leave it and move on. My brother, you can't kill yourself. All right, so that is for this particular question. Let's see whether we can solve a question on statement of financial position.
Where is the 25 coming from, please?
The 25 is from these people. Let me see.
Oh, okay, I've seen it. The other compensatory.
Yes, please. All right. Okay, let's see we can do justice to this question, although it's somehow plenty. Okay, let's see whether we can try the question. It's somehow plenty, but let's see. Auntie, St. Augustine, are you there? Yeah, St. Augustine. Or should we explain the footnotes?
Yes, sir.
Okay.
Senior, let's explain the footnotes.
Okay. So what we do now is we also start. We can put a skeleton there because the parent will always be what? The who. Okay. So you can start by your statement of financial position. You put your PP, then you put the whole figure there. The investment you can put it there, but the investment will always be the amount that they have invested in the subsidiary, which the share capital of the subsidiary will cancel it. But you can put it there. Sometimes there can be other investments. So we are going to reconcile that particular investment. Then you also pick, you can put goodwill there. You can put goodwill. Or you can, after doing the property investment, then you leave like maybe 3 or 4 spaces because goodwill will come there. Maybe other assets will also come there, or investment in associate will also come there. Then you count your current asset. You pick only the parent own. If you count to the share capital, the investment will cancel the subsidiary's own. So we don't bring the subsidiary's own. So bring only the parent own. The retained earnings will only show the parent own because the subsidiary's own will be shared among the parents and then the NCI. So the subsidiary own will be added to the NCI and portion of it will be added to the what? To the parents. So the subsidiary capital items will be consumed by what? The parent and then the NCI. So we only bring the equity items of the parents. So the share capital will be only the parents. The retained earnings, you don't put anything there. The other component of equity, you don't put anything there because you are going to do workings for them. Then you bring NCI. Okay. Then if you count to this one, you have your non-current liabilities. You bring only the parents. Then you count to current liabilities. You have your trade and other payables. You bring only the parents. You have provision for liabilities. You bring only the parents. Then after doing this, you can come and scan through the question to see who is the subsidiary and who will be the subsidiary for full year, because this question is for a disposal. So some of the subsidiary will be disposed during the year where the parent will not be having control. Since the parent is not having control, for statement of financial position, we don't consolidate for a month. So as at the date of reporting, is the parent still the owner of that particular company? If no, the parent cannot consolidate them. It's only profit or loss that we find the portion of the profit that we want to have a share of. The statement of financial position is prepared as at the day that you are preparing this statement, is the parent still owner of the subsidiaries? No. So we don't consolidate them if control is lost for statement of financial position. So you scan through and ask yourself, which of these subsidiary is the parent still having control over? So the parents acquire 60% of Keta. Okay, let's read through and see whether they have disposed some of it. Okay, they also acquired 85% of Akachi. Let's see whether they have disposed some of them. Okay, on 30th, on this one, who disposed 25% of equity in Akachi. So they are having 85%. They dispose 25%. They will still be having 60%, still control. So they can still consolidate that particular one. So yes, you don't do anything. So you consolidate all the two, because although they dispose 25%, they will still have 60%, which is control. So you consolidate all of them. Then after confirming this, you come and add their figures again one by one. You add their figures one by one. then you will now see whether you can put a group structure there. The group structure will be the parent, which is whole, will be having 60% of Kata, and they will be having 85% of Akachi to some dates. They will have it from July to 30th September. So from 30th September, they will now be having 60%. So you can also demonstrate that you put a post-acquisition date for the two of them, and you also put a reporting date for the two and the post-acquisition period for the two. Okay, let's take this one. So, Senior Augustine, read the footnote one for us.
Okay. On 1 June 20X8, who acquired 60% of the equity shares of Keta, a public limited company. The purchase consideration comprised cash of 250 million and contingent consideration based on turnover. At 1 June 20X8, the amount payable under the contingent consideration was assessed as 50 million, but had decreased to 40 million on 30 November 20X9. The contingent consideration is not recorded in the above financial statement. Excluding the franchise referred to below, the fair value of the identifiable net asset was 360 million. The excess of the fair value of the net asset is due to an increase in the value of non-depreciable land. Keta held a franchise right, which at 1 June 20X8 had a fair value of 10 million. This had not been recorded in the financial statement of Keta. The franchise agreement had a remaining term of 5 years to run at the date and is not renewable. Keta still holds this franchise at the year end. Who wishes to use the full goodwill method for all of its acquisition? The fair value of the non-controlling interest in Keta was 150 million on 1 June 20X8. The retained earnings of Keta were 115 million, and other components of equity were 10 million at the date of acquisition.
Yeah, are you done?
Yes, yeah, I'm done.
Okay, sorry. Okay, so what's the purchase consideration here? How is
250
the
million,
okay? They are having a cash of what? The purchase
250
consideration
million.
is 250, and also a contingent consideration based on turnover, isn't it?
Yes.
Okay. At 1st June, which is the acquisition date, the amount payable under the contingent consideration was assessed as what? 50 million. So the total consideration will be 300 million at the date of acquisition. So you have your cash consideration plus your contingent consideration of 50 million. But this had decreased to what? 40 million at 30th November 2X7. Okay. So you are saying that you paid them 50 million. Now it has now reduced to what? 40 million. What is happening there? There will be a gain of what?
10.
10 million, which will be sent to what? Retained earnings of the parents, because it's the parent that is what? Paying these amounts. So they say that this particular figure is not yet recognized. Please, we don't do, for statement of financial position, we don't do prorating on monthly basis. If I have acquired your company at the date of reporting, I'm the owner of your company at the date of reporting. So I can report all the assets that I have acquired from you. I'm the owner. It doesn't matter the number of months that I've acquired. It's only profit or loss that we look for the number of months share that I will have of the profit. The number of months share I will have out of the profit. That is what we do for profit or loss. For statement of financial position, we don't do monthly consolidation. Even if you are selling your car to me at the end of the year, as soon as you have sold the car to me, I'm the owner of the car as at that date. So we do consolidation. Even last date, we do consolidation. So we don't do monthly one. Okay. So your purchase consideration will be 300 million, which will be the cash consideration plus the contingent what? Consideration. They are saying that the contingent consideration is not recorded in the above financial statement. Contingent consideration is what? Is it a liability or asset to the parents?
A liability.
It's a liability. So the liability, you'll be showing the figure at reporting. So the liability will be 40. So you add this one to your non-current liabilities depending on.
You can introduce your whiteboard.
Okay, okay.
Mm.
So okay.
When you see someone who
So,
has chatted, you respect the person.
so our purchase consideration will be cash of 250 plus the contingent consideration at the date of acquisition. We are doing this at the date of acquisition, so we use their fair value. That will be 300 million. But this is yet to be recognized. So you can assume that you have recognized it at acquisition. So you go to your liability, you have your contingent consideration or liability of 50 million. That is at the date of acquisition, but now it is now 40, so you subtract the 10. So now have the 40. This 10 will be sent to the group retained earners of the parent, because the parent is supposed to pay 50. Now they are saying that they should pay 40. They are having a gain of 10. That 10 will go to the group retained earners. Okay. Let's now look at other issues there. Okay. Excluding the franchise referred to below, the fair value of the net asset was what? 360. This is as what? At acquisition, isn't it? All right. So let's look at the net assets here, and then what will be the net asset from the book. So we have the net asset to be 360. This is excluding issues about franchise. Okay. But let's come to what they are saying over here, what we'll be saying over here. They say the excess of the fair value of the net assets is due to an increase in the value of non-depreciable land. Keta had a franchise right, which at 1st June had a fair value of 10 million. This has not been recognized in the financial statement of Keta. The franchise agreement had remaining term of 5 years to run at that date, and is not renewable. Keta still holds this franchise at year end. Who wishes to use a full goodwill method for all of its acquisitions? The fair value of the non-controlling interest in Keta was 150 million on 1st June. The retained earnings of Keta were 115 million, and other components of equity were 10 million at the date of acquisition. So let's determine our net assets, the net assets from the books of the company at the date of acquisition. So let's assume that we have at the date of acquisition, and we have the reporting. Okay. So let's count to Qatar. This will be for Qatar, the net asset for Qatar. Okay. So we have the at acquisition and at reporting. Okay. So the first item will be the share capital. Are we okay? So the share capital for them is what? What is their share capital? For Qatar, what is their share capital? It's 230.
230.
Okay. That will be the same for acquisition and for reporting. What is their retained earnings at acquisition? The question has given that to us.
170.
170. Okay. Reporting is what?
Sorry, reporting is 170. Sorry.
Okay, reporting is 170. They have given the acquisition to us at,
Acquisition is 115.
okay, 115. Other reserve is what?
Reporting is 14.
Okay, that is other component of equity is 14.
Yeah.
Okay, at acquisition was what?
10.
Okay, it was 10. Okay, so let's be getting it over here. That was 10. Okay. What will be the net asset from the perspective? What is the book value of the net asset? What's the book value of the net asset at acquisition? The book value, the one given to us is the fair value. So what will be the book value of the net asset? The figure that we have from their statement of financial position. I'm getting 355.
Yes.
Okay, but they are saying that it's now 360, isn't it?
Okay.
They are saying 360. Okay, and they are saying that the excess is what?
Non-depreciable land.
Non-depreciable land. So what you do now is you find the book value of the book value of the net asset, which is based on the normal way of calculating the net asset. You pick their value from the statement of financial position. That is the book value. What is now the fair value given to you? The difference, the question will tell you the difference. So they say the non-depreciable land. But if this should be a depreciable land, then we charge the depreciation from the date of acquisition to this particular date, to the reporting date. That will be from June 20x8 to November 20x9. How many months is that?
18 months.
It will be 18 months, 1.5 years, isn't it? Okay.
Yes.
They are saying that the 360 given to us is excluding what? Franchise, isn't it?
Yes.
Okay.
Okay.
Okay. Let's now come here. What will happen to the 5 million? How do we do the 5 million? We go and add it to PP, isn't it?
Yes.
The 5 million is yet to be recognized. So you go and add it to PP unless the question says that the fair value adjustment has already been taken into consideration. So you only report it at what? You only show it at acquisition because they have done the reporting one already. So you don't put it there again. Okay. So the 5 million will be shown as both acquisition and reporting. But if the question says that the fair value adjustments has already been taken into consideration, then you will not show it at reporting. It means that they have already added it. So you only show at acquisition because it will be recognized after the acquisition. So you only show it for acquisition, not reporting. But we assume that it is years to be recognized. So you put the 5 million at both acquisition and reporting. Then you will now go and add it to your PP because the value of the land will be increasing, which is years to be recognized in the financial statement of the company. Okay. So let's come here. Qatar had a franchise which at 1st June 2x8 had a fair value of 10 million. This has not been recognized in the financial statement of Qatar. So at the date of acquisition, what do we do? What do we do? At the date of acquisition, what do we do? We have to
recognize
the
10
franchise.
million.
Okay. Any contingent liability assets that the subsidiary is having, when the parent acquire them, the parent has to recognize all those things because if those things to crystallize during the year or they should materialize during the year, the parent will have the benefit of it. So the parents have to pay for them. All right. So the franchise at acquisition will be 10 million. But let's come and see whether it will be the same for reporting. Okay. Let's say that the franchise agreement had a remaining term of 5 years to run at that date, and it's not renewable. Qatar still holds this franchise at the year end. Qatar wishes to use a full goodwill method for this one, and a non-controlling interest it is. Okay, so at the date of reporting, the franchise has a fair value of 10 million from the acquisition date, which is 1st June, to 30th November 2x now. That is 18 months. Would the value still be 10 million? The franchise
No.
has only 5 years. Will it still be 10 million?
No.
Okay. So you go to your financial statement, then you now have intangibles because you have to recognize the franchise now. So you have intangibles of 10 million. But what is going to happen is that you have to calculate depreciation of the amortization of the franchise. Okay. The amortization will be 10/5 times 1.5. Am I correct?
Yes.
Okay. What are we having?
3 million.
So it means that the value now will be what? 7 million, isn't it? So you come
Yes.
to reporting and put 7 million there. Or you can put 10 million, then you now bring amortization as an item on each one, which will be 3 million. You are using time, so you just put the value at reporting. So you have your intangibles, or you put a franchise there, then you have 10 million minus 3. You report 7 million. Okay, so you now total this will now be 370. So your purchase consideration will be 300. Then your net assets. So you add your NCI. So you have the NCI to be how much? How much was given to us as the NCI? 150. Okay. So we add the NCI of 150 and now have 450. So we take our net assets of 370. Then we now have goodwill as 80. So that will be the goodwill on Keta. That is very simple. You move on from that particular side. You don't have any problem again. But you calculate your post-acquisition profit on Keta. So what will be the post-acquisition profit? Let's calculate the post-acquisition profit for Keta. I'm having 56. Can someone confirm that?
Yes,
Confirm.
senior.
Okay. This 56 is not all of them that is for that is profit. Okay. You can see that we have other components of equity of 4, isn't it?
Yes.
So you have to split this one. Post-acquisition profit will be 52. Other components of equity will be 4. So you share it among them. The parent will have 60% of this. NC will have 40% of this. The parent will have 60% of this. That will be sent to other components of equity. NCI will have 40% of this. That will be added to the NCI. So from this one, you are done with the statement of, you are done with the footnote 1, which is very plenty. And it's okay. There's no problem with that. Let's see. Okay. The remaining one we can just go through them in the okay. The second one is the B. The B is the one that is also plenty. Okay, so we are done with the A. Okay, let's come to the B. Okay,
On 31 July 20x8, Ho acquired 85% of the equity interest of Akachi for a consideration of 214 million. The consideration consisted of cash of 134 million and equity shares of Ho.
okay. How much?
The
How much
equity
are they? How much are they paying as the equity shares? They are doing share exchange. The equity shares. What they are saying is that they are doing share exchange. Are you okay? Okay. How much are they recognizing as the equity as the share exchange? What will be the value that they will be giving in return for the shares? What will be the value of the shares that they are giving? the total consideration is 214. They are paying a cash of 134. So how much are they giving as shares? Or what is the value of the shares that they are giving?
That's 80.
That is 80, isn't it? Okay.
Yeah.
This 80 will do what? What will be the impact of the 80 on the shares of the company, on the equity capital of the parent?
To reduce.
No, please. Don't think that the existing shareholders will go. No, they will not go. The existing shareholders will still be there before these people
So
will
to be
also come.
diluted. Oh,
Now it will be added. It will increase their value of the shares. Okay. So what is happening is that we have 10 shareholders now, and we are taking 5 people from the subsidiary again. It means that we are going to be having 15. Not that 5 people will be leaving and we come and replace them. No. The existing shareholders will be there before you be adding the new shareholders again. Or the assumption is that you can assume that the 80, the parent has issued new shares for cash, and they are using the cash to pay for this particular one. So if they are issuing new shares for cash, then it means that we are going to be debiting cash, 80, and crediting what? Equity by 80. But we are using this 80 cash to pay for the consideration. So we are going to be debiting the investment. We are going to be debiting the investment of 80, and we are going to be crediting the cash of 80. So you can see that the equity will still increase. That is also another way of looking at it. But what you have to know is that the existing shareholders of the parent will be there before these shareholders will come again. So you go to statement of profit or loss. You go to the statement of financial position, then you add 80 to the share capital of the parents. So if there's a share exchange, the share exchange will increase the share capital of the parents. They have the existing shares and they are now issuing additional shares. So that will be the 80 will be added over there. So let's look at something before let's look at something. Let me look at something. For the two companies, what is the total consideration are they paying for them? What is the total consideration are we paying for them? Or what is the total consideration that was recognized? Okay, you can see that.
514.
Okay, the first one, no. Some of them were not recognized.
564. Sorry.
The first one, they recognized only the 250. The contingent consideration was not recognized. So they recognized only 250 in their books. Okay. The second one too, it was only the cash that is recognized. The equity shares is yet to be recognized in the above account. So it means that the figure will be 134. Okay. So the total consideration recognized is 384. Okay. Let's go and look at the investment that the parent is having there. What is the value of the investment here?
490.
What is the
490.
investment?
106.
Okay, so we keep this 106 for now. So you subtract the 384 over here. The 384 is the investment made in the two subsidiaries, which was recognized. So it was a two cash considerations that were recognized, which is 384. So out of that one, there's a difference of 106. We are going to rectify
It's
the
374 rather. It's 240 and 134.
they recognized 250 for the first one.
250 rather.
Yes, for
Yes.
250. The purchase consideration comprised cash of 250 and a contingent consideration based on turnover.
Thank you.
All right. So the 106, we are going to rectify where the 106 is coming from. Okay. So you have to know that the total consideration that they are paying for these people is 284. So the total consideration for them is 284. So consideration will be 284. You can split it cash and 234. So you can split it cash and that one will be the 214 rather. Right. So 214. and that is the consideration 214. So let's determine their net assets. What will form part of their net assets. Okay. The equity shares is yet to be recognized in the above accounts. The identifiable net asset of Akachi had a provisional fair value of 202, including any contingent liabilities at the date of the business combination. Okay. Akachi had a contingent liability with a fair value of 30 million. Okay. At November 2x4, 2x9, the contingent liability met the recognition criteria of IS 37 provisions and this one, and the revised estimate of this liability was what? 25 million. Okay. At the time of the acquisition, at the time of acquisition, what was
30 million.
it was 30 million. Okay. But they are saying that this has already been recognized in the what? In the 202. There they are saying. So they are saying that the provisional fair value, including any contingent liabilities, is 202. So the 30 million is already part of it. So what we do now is, since we have recognized the contingent liability of this one, you also go to your provisions. You have an item over here which is provisions. So you count your provisions, then you now have your provision for liabilities, you add a 30. That is at the date of acquisition. But they are now saying that this has now been revised to what? And the revised estimate of this liability was what? 25 million. What is happening there?
It has reduced.
It
So
has
there's
reduced.
a new
Okay. So there will be a gain of what? 5 million.
5.
But that gain is relating to what? It's relating to the subsidiary. So this is how you do the subsidiary net assets. So let's show the subsidiary net assets here. So let's count the subsidiary net assets for, you can see that they haven't given us the retained earnings, isn't it? But we can be able to do something about it to find the retained earnings at acquisition and also at reporting. So let's see whether they have given us any issue on the retained earnings over here. Okay, however, who had not completed the valuation of an element of property, plant, and equipment? Akachi at 31 July, the revaluation was not completed by, okay, the revaluation was received on this one. The excess of the fair value of our book value at the date of acquisition was measured at 4 million. The asset has a useful economic life of 10 years at this one. The retained earnings of Akachi were 73 million, and this one on the date before any adjustment for the contingent consideration. Okay. So let's look at the net assets. What is their share capital? What is their share capital for them? The share capital for Akachi is how much? Would that be 150?
I think so. Check from the question.
Okay. Their retained earnings is what?
150. 150. Retained earnings is 65.
Okay.
Total
And
components of equity is 17.
okay, that is at,
No, these are reporting.
okay, these are
Reporting. Sorry, as reporting.
reporting is 65 and 17. Okay. Let's look at acquisition. They have given us those figures for acquisition there. Okay. So they say retained earnings and other components of equity were 73 and 9. So it means that they made a loss during the year. Okay, so there will be a loss. So the retained earnings was 73 and other components of equity was 9. So we have 7, 3, and 9. Okay, let's now count to the liability, which is the contingent liability. This will be 30 and this will be 25. Am I correct? Okay. What is the figure given to us? 150 plus 73 plus 9 plus 30. What is the figure given to us as? What is the net asset given to us?
$202.
And what is the net asset that we are getting? What will be the book value of the net asset at acquisition?
Having 262.
That will be 262, isn't it?
Yes.
Yes, 260.
So how come that they are giving us 202? So you see, it means that the figure have to be adjusted, isn't it? Because if that is including the, so this is likely to be 282. Okay, so let's assume that that is 282. So if that is 282, because the liability is included in that particular one. So if that is 282, then it means that there will be an increment of what? If the provisional value is 282, then there will be increase of what? 20, isn't it?
80.
Okay, the figure that we have, the book value is 262, isn't it?
Yes.
Okay.
Yes.
Okay, if you do it correctly, we are having 262, but let's assume that this is 282. So what will be the difference?
20.
Okay, that 20 will be attributed to what they are saying here. Okay, however, who had not completed the valuation of our element of property, plant, and equipment. So we have recognized the provision already, isn't it? All right.
Yes.
So the company has not what completed the valuation of the property, plant, and equipment of Akachi at 31 July 2x8, and the valuation was not completed by what? November 2x8. Okay, so it means that the provisional value that was given to them for the property, plant, and equipment will be 20 at the date of what? At the date of what? Acquisition, isn't it? That is the difference between the 262 and 282. Are we okay?
Yeah.
Okay.
Okay.
Okay, and the valuation was not completed by that one. The valuation was received on 30th June 2x9, and the excess of the fair value over book value at the date of acquisition was measured at what? 4 million. So it means that the total value will now be 24 million, isn't it?
Come again.
Okay, the provisional value given to us was 20 million at acquisition, isn't it?
Yes.
Okay, they are saying now that the excess of the fair value over book value, the valuation was received on 30th June 2x9, and the excess of the fair value over the book value at the date of acquisition was measured at 4 million. So in all, the total value should have been 24, isn't it?
Yes.
Okay. You can, okay, I will draw you back to the asset had a remaining useful life of 10 years at 31 July 2x8. So let's now ask ourselves that how many months have we done so far? How many months have we done? Because we are preparing this on 30th November. So from 1st July to 30th November, how many months is that? Or how many years is that? 1st July, 2x8 to
5 months.
it is 30th November 2x9.
Oh, okay. So I think 17.
That would be 17 months, isn't it? Okay.
Yes.
Are you sure? Are you sure? From July to December is what? It's 5 months.
It's 5 months.
9th
Okay.
December. Oh, okay, yeah, 31st is 5 months.
Okay. Then the remaining one, the remaining one will give us 11 months, isn't it? Because it will be from 1st January
Okay.
to 30th November.
No, November. Okay.
So that will be 14 months.
It will be 16.
16.
16. Okay. Okay, that will be 16. So the second one will give us 11 months. That will be 16 months. Okay. So we have acquired them for 16 months. Okay. We have acquired them for 16 months. You see, I'll draw you back to a question. You see, the pre-more question, there was a question that I said that the company has what we call a reporting date, isn't it? I don't know whether you can still remember that particular question.
Yeah.
Yeah. The company has a reporting date. That reporting date, if you have a valuation, maybe you are going to do a valuation for some of the assets, they will give you a provisional valuation. If the final valuation will be given to you before the reporting date, you have to take the final valuation as if it has been given to you at the date of acquisition. So this 24 million will be seen as a value given to us at the date of acquisition. That is what the reporting date is talking about. So you are going to be given a period. Okay. During this period, if the valuation is not completed, you wait for the valuation before you consolidate. But if the valuation was not given to you before the reporting date or before you prepare your financial statement, then you have to just use the provisional value given to you. But if the valuation was completed before your reporting period or within your reporting period, then you have to take the final valuation as if it has been given to you at the date of acquisition. So the valuation that you'll be receiving will be having a retrospective effect. So you'll be taking this value as 24 million at acquisition. So your net asset at acquisition will be 282. Will be 282. But if you have already calculated the goodwill and those ones before they give you the valuation now, then you treat the valuation as what? As a revaluation gain. But now we are coming to do the consolidation. So we assume that the valuation is given to us. Now we are coming to do everything about consolidation. So we treat it as if it has been at the beginning or it has been given to us at the date of acquisition. So our 282, which is the net asset, will now be increased to 286 at the net asset at acquisition. Net asset at acquisition. All right. So the net asset acquisition will be 286. Then we take our non-controlling interest of 38 from it. What are we going to be getting?
I'm getting 248.
And I'm okay, 248. Okay, that will be the net asset. But this one, I don't know the actual figure over here. I don't know whether they are going to be having a goodwill or gain on bargain purchase, but they are going to be having gain on bargain purchase because they are paying less for this particular one. So that will be a gain on bargain purchase. But I'm going to confirm the 202 as the actual figure. So I'm going to confirm the 202 as the actual figure. So that is how about the provisional valuation. The provisional valuation is going to be having a retrospective effect. You just take it as if it has been given to you at the date of acquisition. That is the reporting period issue. Okay, so that is for this particular one. And you just do your net asset very well. And you go and add the 24. This 24, you have used it for 16 months. So you calculate your depreciation on it. The depreciation on it will be 10 years. So we have the 24 over 10. But since you are going to do it on monthly basis, you can do your 24 divided by, so 10 times 12, that will give us 120. So you can do over 120, that is monthly basis. Then you now multiply by 16 because it's 16 months. So you have 24 over 120 times 16. I'm having 3.2. So you are going to use that particular plant and equipment for 16 months. So you calculate the depreciation on the full amount. So you have 24 under acquisition and 24 at reporting, but you bring a depreciation of 3.2 at reporting. But if you go to property, plant, and equipment, you add 24, then you now subtract 3.2 because you have used 3.2 out of that particular value. The value should be incorporated at the date of acquisition, but you are preparing your financial statement at the reporting date. So you have used the asset for 16 months. So the value can no longer be 14 again, can no longer be 24 again. So you take it from that particular value. All right. Okay, let's look at the C. Let's look at the C.
See,
Yeah.
on 30 September 20X9, who disposed of 25% of the equity shares in Akachi to the non-controlling interest for a consideration of 80 million. The disposal proceeds had been credited to the cost of the investment in the statement of financial position for the year ending the 13th November 20X9, Akachi 4 million respectively.
Okay. When was the disposal done? 30th September, isn't it?
Yes.
Okay. So let's now come here. The 80 million has been what? Credited to what? The cost of investment, isn't it?
Yes.
Okay. Crediting it to cost of investment means that they have subtracted it from the cost of investment. Okay. So it means that the investment should have been 490 plus 80. That should have been the total investment.
570.
That would be 570, isn't it? Okay.
Yes.
Out of this, 250 is for the buying of the cutter, and the 134 is for the buying of that one. So what will be the difference? 570 minus 250.
186.
Okay, we are having 186. This 186 will be shown as other investments. So the parent has other investments somewhere, not only the acquisition of the subsidiary. So you reconcile the investment and that will give you other investments. Okay, that is not the issue. Let's come to this particular acquisition. Okay, they are saying that the disposal proceeds had been credited to the cost of the investment in the statement of financial position. For the year ended, Akachi made profit and other comprehensive income of 3 million and 4 million respectively. All right. So the parents still have control of 60%, isn't it?
Yes.
So what we have
Yes.
to do, what we have to do now is that we have to ask ourselves, what is the portion of the net assets? What is the portion of the net assets is the parent what transferring to the NCI? Sometimes the question can give you the portion of the net assets like that, but sometimes they can ask you to calculate it. Okay, so we are selling to them on 30th September. Our reporting date is 30th November, isn't it?
Yes.
Okay. Our reporting date is 30th November. So from 30th September to 30th November, what is happening there? How many months is that?
1 month. No, 2 months, October, November.
Okay, that will be 2 months. Okay. So the question is, we have done 10 months for this year before we are going to dispose them. Okay. This one you can decide to do two issues. You can decide to use the net asset before consolidation. You can use the net asset before consolidation, or you can use the net asset after consolidation. If you are going to use the net asset after consolidation, then it means that you are going to use these figures. So you'll be having your net asset that we have over there will be, the net asset that we have is going to be, okay, let's look at the net asset at reporting. Okay, net asset at reporting will be what? So we are going to be, this is their figure, isn't it? So net, we are going to be having property, plant, and equipment. And that will be 24. This will be 24. Then we now have a depreciation of 3.2. Okay,
Having 277.8.
okay. 277.8, isn't it?
Yes.
Okay. That is the net asset at what? At acquisition. We don't have good
Reporting.
at reporting rather. We don't have goodwill, isn't it? They're having a gain on bargain
Yes.
purchase, so we don't have a goodwill. So what we do is that we just find 20% of the net asset at reporting. Okay, but the net asset at reporting over there is don't take it yet. Don't use it yet, because you can see that this figure is for full year. Okay, this is reporting is 30th November. But we sold the thing on 30th September. It means that we have to do only 10 months. We have to do only 10 months. Okay. So what you do is you come here. What is the profit made for this year? The question says that it's 3 million, isn't it?
Yes.
The question says that the profit made for this year is 3 million. And depreciation will be reducing it by what? 3.2. That means we are making a loss. Depreciation will be 3.2. So we are making a loss of what? 0.2. Is that correct? Okay. So we are going
Yes.
to make a loss of 0.2. Okay, this 0.2, we are going to be having 10 over 12 of it. So the remaining 2 months will be for the remaining 2 months, which will be October, November. But let's count to other comprehensive income. Do we have Akachi made a profit and other comprehensive income of 10 million and this one. So this one is the other comprehensive income is the other component of equity. This other component of equity, we are going to be having, the one that we have over there is a full year. So what do? Let's take only 2 months out of it. So 2 over 12 times 4 million. What are we getting? And so we just find 2 over 12 out of the profit or loss items. And that will give us the remaining issues. So 2 over 12 times the reporting figure, we have recorded all the 4 million. We have to record only 10 months.
It's 0.67.
Okay, so 2 over 12. 2 over 12 times 4 million. Okay, 0.67. Or let's make it 0.7. Okay, so it means that this net asset over here, this one that we are getting over here, the answer that we are going to be getting, we have to take 0.7 from it. 0.7 relating to the profit for the last 2 months, but we have done only what? 10 months. So just find your net asset at the beginning, then you add 10 months of the profit for this particular year to it. That will give you your total net asset at the date of disposal. So since we have included the last 2 months over here, because we are having a full year other comprehensive income for this year. So we have included all the 4 million. So let's just take the 2 million out of it and subtract. Let's count to the loss. The loss will be adding because the loss will be reducing our profits. So that will be, the loss will be 2 over 12 times 0.2. What are we having?
0.03.
So 0.03. So 0.03 will be added. So if you add, because I'm sure that particular figure over there, the other comprehensive income, I didn't check the question very well. So that's why we are having problem with the adjustments. But let's add and see. We have 150. So 10 over 12 times 3 million, 2.5. Okay, 10 over 12 times 3.2. What are we having?
$277.07.
Okay, 277.
0.07. The profit made, are we multiplying it by 2?
The profit, this one, okay, what you do is this place, okay, you can stop here, or you can subtract 3 million from this. Okay, what we are doing is that the 3 million is only 10 over 12 that will be bringing over here. So 10 over 12 times this, it will give us 2.5. Then the depreciation to be doing only 10 over 12 for this year. Okay. Now, the depreciation is in full year. This depreciation is for 16 months, isn't it?
Yes,
Yes.
the 3.8 for 16 months.
Okay, so it's supposed to be 14 over 16, 3.2. Because it's only 2 months of it is for the year before. We have done 14 months before we dispose the share. So the remaining 2 months will be for this. So it will be 14 over 16, not that one. So it will be 14 over 16. So let's take it like this. Okay. So let's assume that the 3 million is not
2.8.
included here. Okay. So let's assume that the 3 million is not included over here. So we'll be having 62, isn't it?
Yeah.
Okay. Let's assume that the 4 million of other comprehensive income too is not included over here. So we'll be having 13. Okay. So the liability and all those things will be here. Okay. So right now, let's come. We are going to be adding 10 over 12 times the other comprehensive income. That will give us how much?
3.33.
3.33. So let's have 3.3. So we are adding the 10 months. Okay. This is the one at the beginning. So we are adding the 10 months to make it at the date of the disposal. Let's now count to the profits. The profit will be having 10 over 12 times 3 million. What are we having? 2.5. So we'll be adding the 2.5. Okay. Then we now have the depreciation. The depreciation will now be 14 over 16 times 3.2. What are we having?
2.8.
2.8. So the total now will be the net asset at the the date of the disposal. But sometimes the question can tell you that you should use the net asset before adjustment on consolidation. So you forget about the post-acquisition consolidation items. So if you add all of these ones, that will give you the net asset. If you have goodwill, then you add the goodwill before you find the NCR portion. But since we don't have a goodwill, we have a gain on bargain purchase. You just find the NCA share of the value here. What are we getting as total value?
$277.
Okay, 277.
7.
Okay, so we just, if we have goodwill, we add a goodwill to get a net asset before we find the 25%, because they are using fair value for the NCI. But since we don't have the goodwill, what we do is we just find 25% of this one. That will give us the portion that we are selling to the NCI. So 0.25. What are we getting?
$69.25.
69.25. But how much are we receiving? We are receiving 80 million. What is the difference?
$10.75.
Okay, so this will be sent to other components of equity. The 69.25 will be added to the NCI. We are going to transfer 69.25 to NCI. That's how we go about it. So if you have goodwill, then you add a goodwill. But since we don't have goodwill, that is all. Someone can also decide to find it from the NCA perspective, but that is going to be to, I will check the question again. Maybe some of the figures are not, especially the net asset figure. Okay, so that is for that one. You just determine the net asset at acquisition. If you have goodwill, add a goodwill. Then you just find a portion that the parent is selling to the NCI. Then you compare. This one, they are using fair value method for the NCI. So you add a goodwill and find the percentage. But if they are not using the fair value, then you just find the 25% on the net asset without the goodwill. Okay, let's look at the D.
The D.
Okay, I'm sure that the D and the.
I mean, right now, my brain go this thing.
Okay, let's look at D and then the E and C. Okay, they are the two ones they are the two remaining ones. Let's see whether we can finish them.
D. Who acquired a plot of land on December 1, 2008 in an area where the land is expected to rise significantly in value if plans for regeneration go ahead in the area. The land is currently held at cost of 6 million in PPE until who decides what should be done with the land. The market value of the land at 30 November 20X9 is 8 million, but as at 15 December 20X8, this had reduced to 7 million as there was some uncertainty surrounding the viability of the regeneration plan. It is a group's policy to maximize return on capital employed.
Okay. So how are they going to classify the land?
Investment property.
Investment property, because a land held for undetermined purpose will be classified as what? Investment property. That's what the standard says. Because they are here to determine their purpose for this particular land, and even they are keeping the land for significant rise in value. Okay. Okay, so this will be classified as what? Investment property. This has already been recognized. So what will happen is that at the end of the year, what happened? The value
There
has
was a
increased.
gain.
There was a gain of what? 8 million. Okay,
of 2 million.
of 2 million. Yes. So the value is now 8 million. But as at what? 15 December 2x9, this has reduced to 7 million as there was some uncertainty surrounding the availability of the regeneration plan. It is the group policy to maximize return on capital employed. Okay. So what are they saying? You can see that is an event after reporting date, isn't it?
The reporting, yeah.
Okay. But since this event after reporting this is an indicator of impairment, isn't it?
Yes.
Okay. The meaning is that the actual value of the land at the reporting day should have been 7 million. Impairment of assets is what is adjusted against the what is an adjusting event. The meaning is that the asset was classified at a value higher than what the next realizable value. And unless they are saying that the value has increased. If the value has increased there, we don't do anything, we don't adjust it. But if it's going to be a reduction in the value, it means that at the reporting date, you have classified the asset at a value higher than the net realizable value. So you still go and subtract 1 million from that particular one as maybe you can say as an impairment of the asset or as a reduction in fair value. So in all, you'll be recognizing a gain of 1 million. But if the land should have been increased to 8 million, it means that at the reporting date, the land is carried at a value lower than what the recoverable amount or the net realizable value, which means that the land has not impaired. All right, so this reduction is an indication that the land has been carried at a value higher than its actual value at the reporting date. From 30th November to 15th December, that is 15 days. How can the value reduce like that? It means that the actual value should have been 7 million, but you did something to increase the value. So this will be adjusting events. You come back and reduce your gain by 1 million, or you only recognize 1 million gain on that particular one. All right, let's look at the E. You add only 1 million to the property, plant, and equipment and recognize 1 million in the retained earnings of the parents. Let's look at the E, and we see that we are done.
Who has a property located in a foreign country, which was acquired at a cost of 8 million dinars on 13 November 20x8, when the exchange rate was 1 cedi to 2 dinars. At 13 November 20x9, the property was revalued to 12 million dinars. The exchange rate at 13 November 20x9 was 1 cedi to 1.5 dinars. The property was being carried at its value as at 13 November 20x8. The company policy is to revalue PPE whenever material difference exists between book and fair value depreciation on the property can be assumed to be immaterial. Depreciation on the property can be assumed to be immaterial. Sorry.
Okay. So when was the asset acquired?
November 20x8.
Okay, that was 1 year a year ago, isn't it? Okay.
Yes.
And it was acquired for what? 8 million dinars, isn't it?
Yes.
Okay. Who is operating which company, which country? Ghana, isn't it?
Yes.
Okay. So it means that at the date of the transaction, we have to translate the foreign currency to the Ghana currency. So they are saying that one cedi is equal to what? 2 dinars. So how many CD will be equal to 8? Are we dividing or we are subtracting?
I think we are dividing.
Okay, so if you are dividing, what will be the value? It will be 4 million, isn't it?
1 million. Yes.
That will be
Yes.
4 million Ghana cedi. Okay. But this one, there is no depreciation. If there should be a depreciation, then we depreciate the land to find the carrying value at the date of the what? The revaluation. But they say the depreciation should be considered to be what? Immaterial. And we are not giving.
Linus.
Yes, yeah.
So here you depreciate in CD and then you find the carrying value in dinar.
You find the revalued amount in the revalued amount given to you is 12 million. So you find after translating, you depreciate in Ghana cedi. So you now calculate the depreciation on this one. So assuming that the useful life is 4 years. So it means that at the end of the year, which is 30th November 2x9, our carrying value will be 3 million. Okay.
3 million, okay.
Okay. Then they have revalued the asset to what? 12 dinars. Then we find the CD equivalent of the revaluation to compare with the 3 million that we have. So for property, as soon as you translate the figure, you don't do anything again unless it is carried at fair value. So you look for the fair value at the time of the revaluation. So at the date of the transaction, the company is going to recognize this particular asset at 4 million in the Ghana cedi, and that is the end. So they will be what? They will be depreciating it on the what? On the over the useful life, and the depreciation that they will be using will be the what? Will be the Ghana cedi, because they will not be using dinars. Their presentation currency is not the dinar, it's the Ghana cedi. So the time that we bought the machine, what is the CD equivalent that we have used to purchase the machine? It means that we have bought the machine at 4 million, because it is 4 million Ghana cedis that we used to pay for the 8 dinars. So in our currency here, we bought the machine at 4 million. So we'll be using the 4 million for 4 years. Every year is 1 million. So we'll be having a recurring value of 3 million. But we are revaluing the what? The property, and the revaluation is done in dinars. So you just ask yourself, at the date of the revaluation, which is this date, what would be the CD equivalent of what? The revalued amount. And that would be 12 divided by 1.5. What are we getting?
8.
Okay, so that would be 8. So 12 divided by 1.5, that will give us 8. So assuming we are depreciating, there will be a revaluation gain of 5 million. Then the asset will still be brought as the 8 million, as a revalued amount. But this one, we are not doing any revaluation. So the asset will still be 4 million against the revalued amount of 8 million. There will be a revaluation surplus of 4 million. So this 4 million will be sent to other components of equity because it's a revaluation. And the 4 million will be added to what? Property, plant, and equipment. Property, plant, and equipment, because they are saying that the property was being carried at its fair value as at 30th November. So they have the 4 million in property, plant, and equipment. So you just go and add the revaluation surplus of 4 million to it. That is all.
Okay, thank you.
Okay. So this is IS 21. Okay. And the last one was 40. Okay. So that is all I'm looking at.
Hello, Senior Linus.
Yes, boss.
Senior, please, this one is off the record. Is OCI the same as other as you said, other component of equity?
Yes, some of people use it like that.
Okay.
Okay.
So
other components of
income is equal to.
equity, yes, it's whenever you are given a question, anything relating to revaluation surplus, send it to the other component of equity. It's just like normal reserves.
Okay.
He
So
asked whether OCI is the same as other components of equity.
Yeah, if you have it in statement of financial position, some people they don't keep. You see the OCI, you can't see OCI in statement of financial position. You either see a revaluation reserve. But in the absence of
Yes.
revaluation reserve, we assume that all reserves are sent to other components of equity. So the other component of equity is just taking other items that are not ordinary what? Income, or other incomes that are not relating to the ordinary business activities. And revaluation gain is part of it. The fair value gain on financial asset carried through other comprehensive income will also be part of the other components of equity. So the other components of equity take into consideration other gains that are different from the ordinary business activities. So in effect, in statement of financial position, it is equivalent to the other comprehensive income in the absence of revaluation reserve.
Okay, sir.
All right, thank you. Okay. So seniors, that is all. That is all for today. Wednesday we look at complex groups. Saturday we finish with the cash flow. All right.